Hello, and welcome to the webinar titled Post-Secure Act 2.0 Actionable Techniques and Sophisticated Strategies in Retirement and Estate Planning. I'm Kathleen Bilderback, and I'll be your moderator today. Thanks for joining us. The Society of FSP and NAIFA have come together to create the Advanced Practice Center, with the goal of giving financial service professionals access to the most current information and leading authorities in their respective disciplines. This webinar focuses on helping you elevate your level of service to retirement and estate planning clients with savvy insights and strategies in this Post-Secure Act 2.0 environment. We'd like to thank our sponsors for this webinar: Emeritus, First Financial Resources, Mutual of Omaha, and Pacific Life. We appreciate your support and sponsorship. Now, a few housekeeping items before we get started. First, this webinar is being recorded, and all registrants will be emailed a link to the recording in about a week. Second, a PDF copy of the presentation material is available in the Handouts tab of the control panel, as well as via the link in your confirmation email. Regarding continuing education credits, for the live webinar, the following credits are available: 3 professional certification credits, 3 CPE credits for accountants, and 3 CFP credits. If you requested credits when you registered, a certificate of completion will be emailed to you in about a week, assuming that you successfully complete the webinar. Also, for accounting credit, please be sure to make a note of the 9 CPE participation codes throughout the webinar. Just to be clear, all 9 of those are not in the first presentation. There will be 3 codes per hour. After the webinar, you will need to enter those 9 codes on the evaluation to be awarded CPE credit. The codes are only needed for accounting credit, not CFP or professional recertification. If you have any questions about CE credits, send a message through the questions tab, and we can just respond to you quickly and directly. And submit any questions that you have for the presenters in the question feature on your control panel as well. We will take questions at the end of each presentation. Today, we're pleased to have 3 outstanding presenters: Bob Kirkland, Jamie Hopkins, and Brandon Buckingham. Our first presenter is Bob Kirkland, JD LLM. Bob is founding partner of the law firm of Kirkland, Woods, and Martinsen, LLP, which has offices in Missouri and Kansas. He works with a variety of individual clients, handling the preparation of estate planning instruments and counseling clients in the areas of estate and gift tax minimization, probate avoidance, gifting techniques, asset protection, charitable planning, and business succession planning. He also advises fiduciaries in estate, conservatorship, and trust administration matters. Welcome, Bob. I'll turn it over to you.
Well, thanks very much, Kathleen. I'm a little nervous because in 30 plus years of doing this, I've never been asked to be savvy, but I'll do my best. So I'm going to kick us off today, and I very often when I do these presentations, I start with the same intro, and that is to challenge you to honestly assess whether out of your total planning time, is the portion of that planning time you spend with retirement assets proportionally appropriate. Now, certainly before 2010, we spent a lot of our planning time talking about and dealing with estate and gift tax planning and minimization. I'm here to make the case that in the current planning environment, we should be spending more time, chances are, dealing with our clients' IRAs and retirement plans. Indeed, according to the Urban Brookings Tax Policy Center, only 0.15% of the U.S. population is subject to estate tax. That's not 15%, that's not 1.5, 0.15%. And this study was done prior to the increased exemptions brought by the Tax Cuts and Jobs Act of 2017. And to the contrary, almost every client we encounter in the planning context has a significant IRA or retirement plan asset with which we should pay attention. And let's also remind ourselves why retirement plans and their benefits are so unique as compared to other assets our clients may hold. First of all, while during the lifetime of our client, while enjoying tremendous tax deferral options, those assets remain pregnant with future income tax liability. The tax man is coming. It's only a matter of when and how hard. Secondly, we all know that maximum funding of retirement plan assets is a very effective and easy asset protection technique. It's low-hanging fruit. I love it when my closely held business clients come in for a first meeting and I ask them if they have a 401k or even a simple plan with their business. And the common response is, you know, I've thought about that often, I just haven't gotten around to it. Yet the first words out of their mouth when we begin the meeting is asset protection. So let's kill two birds with one stone here. We also know, unfortunately, that the mere completion of a beneficiary designation form, which often is done with untrained eyes, greatly impacts the amount, the timing, the tax results when distributions start being made. Also, unlike any other asset, leaving retirement assets to a trust triggers a myriad of complex implications, and now different with the advent of the Secure Act and Secure Act 2.0. Unlike most items of inheritance, every dollar distributed from a IRA or qualified plan to a non-charitable beneficiary is subject to income tax. In some states, like mine in Missouri, I think some of you may be seated in Texas, a beneficiary's interest in a deceased participant's retirement plan can continue to enjoy creditor protection. But of course, the Secure Act impacts that by shortening the distribution period for most beneficiaries. And finally, I believe particularly true under the Secure Act, retirement plan benefits open the door for a variety of proactive charitable planning techniques. I'm probably not going to get to most of those that you'll see in my outline today, but yet they're still there. I really want to, well, one other preliminary comment. We all know the Secure Act was dropped upon us January 1 of 2020. Ironically, it beat the pandemic by about 75 days. What a year. And then in February of this last year, my outline says this year, 2022, Treasury issued proposed regulations under the Secure Act. I, along with about 15 other American College of Trust and Estate Council fellows, spent a couple months, namely every Thursday late afternoon for a couple months, putting together comments. And you can find those on the public side of the ACTEC website. Unfortunately, as of this date, we still don't have final regulations. And what we're told is they're going to finalize those and also issue regulations addressing Secure 2.0 at the same time. So we'll see. I want to spend a bulk of my time today talking about Secure Act 2.0. And I will tell you my experience with it. When I first kind of glanced at it, my reaction was, meh. And then I read it again. And there's a lot of stuff in there with planning implications. So I want to highlight some of those. Of course, the easy implication is the increase of the required beginning date to age 73. We just got increased to 72, and now it's going to 73 after, for those who attain age 72 after 2022. And then again, it goes up to age 75 for those who attain 74 after 2032. So We're creeping up there in our required beginning date. I hope that speaks to our life expectancies as well, but we'll see. Current law allows so-called catch-up contributions. That's not ketchup. Catch-up contributions for persons who are age 50 and older. And in 2023, that catch-up contribution is $7,500. For simple plans, it's $3,500. Secure 2.0 provides that beginning in 2025, and you got to watch this because there's different beginning dates for a lot of these rules. But beginning in 2025, the limit for catch-up contributions is increased for those aged 60 to 63, so a narrow sample size, to the greater of $10,000 or 150% of whatever the 2024 amount is. And those increased amounts are indexed for inflation beginning in 2025. Also, a nice development, Roth treatment may be elected by a participant for employer matching contributions effective in 2023 and for catch-up contributions in years after 2023. Here's a great development because I've had a lot of clients who have fallen into this category. If your client or your client's child is a beneficiary of a 529 plan and they've reached the end of their education and there's still money left in that plan, Secure 2.0 allows them a one-time lifetime rollover of up to $35,000 from the 529 plan to that beneficiary's Roth IRA. The rollover is subject to Roth IRA contribution limits, and the 529 plan must have been in place for at least 15 years. But I had a longtime friend, fraternity brother, who came to see me 3 or 4 years ago, and he and his wife had done tremendous 529 plan savings. And then they had an overachieving daughter. They had one child who was a smarty, and she was also a good tennis player. So she paid hardly a dime for her college. Now, she did a 1-year graduate program in accounting. I believe it was accounting. But she had, 6 figures left in that 529 plan. Now, they were planners also. So here's what they did to relieve part of that. They changed the beneficiary to mom because father had set up the 529 or made the contributions. And she did some graduate work. She does some short story children's books. And so she did 2 years of graduate work, and that was paid for by the 529 plan. But this is a provision that a lot of people will make good use of. I just wish it was a larger amount than 35,000. Maybe that'll happen someday. There's a little known technique that's been around for a while called qualified longevity annuity contracts. So I have clients that come to my office who are 75, 80 years old. They're in pay status on their IRAs, and they're madder than hornets because they don't like those pesky required distributions every year. And I always think to myself, I hope I get to the stage in life where I'm upset when somebody sends me a check. But in any event, these folks are. And so it's up to us to come up with some options for them so they'll leave your office less mad than when they came, and then hopefully pay your bill. But one of those ideas is the qualified longevity annuity contract. And that is one exception to the required minimum distribution rule that you can put. It used to be a low threshold. The Secure Act 2.0 has raised that threshold to $200,000. You can set aside up to $200,000 of your IRA, and there's no longer any percentage limit. So you can set aside $200,000 in a qualified longevity contract that pays nothing to the participant until age 85. So, another 12, 13 years of deferral. So that's something that could eat into those required minimum distributions and make your client happier. I believe that 200,000 is also now going to be subject to, I'm getting beeping on my computer, so I'm going to turn the volume down in case you're hearing it too. Anyway, so here we go. Get rid of that. So yes, that 200,000, I believe, is going to be subject to inflation in years to come. So that technique has been, made more effective by Secure 2.0. Another nice aspect of Secure 2.0, the penalty for failing to take an RMD. And we've seen that a lot over the years. It's historically been 50%, so very draconian penalty if you miss an RMD. That's been reduced to 25%, so cut in half, and maybe further reduced to 10% if the misdistribution is corrected in a timely manner. That's one of those things the new regulations will tell us is what is timely. Another very positive change in the Secure 2.0 has to do with the charitable IRA rollovers. And you're familiar with those. They've had an on-again, off-again history, but now they were made permanent in about 2016 or no, it was before Trump. 2015, they were made permanent. And that's a person who's over 70 and a half, and yes, that threshold remains 70 and a half. They can tell their IRA provider to send up to $100,000 to a public charity. And they can also say that will be my minimum distribution for the year. I don't want any money out of this. So that's another way to combat those minimum distributions. For the charitably inclined client, this is a great planned giving technique. And the good news, if I could find it here, this $100,000 amount or threshold has been in place for a while now. And Secure 2.0 says it will be increased every year with inflation. The other thing Secure 2.0 gave us was the ability to put one time during life up to $50,000 out of the IRA into a charitable remainder trust or a charitable gift annuity, again, for a public charity. Public charity is not a private foundation, but also not a donor advised fund. It has to be the hospital, the school, the regular public charities that we know. So when we think about it, $50,000 into a CRT, I'm not sure that's that helpful because I don't know many people that are willing to pay me or any of us, $2,000 to $4,000 to establish a CRT just to make a $50,000 gift. So, but I do think the charitable gift annuity will be very helpful because that usually doesn't take a lawyer except for introducing the concept. Most public charities have their own forms, their own ability to get those executed. They're usually written pretty plain English. So that will be a useful technique, a $50,000 one time during life redirection of the IRA into a charitable gift annuity for a public charity. So think about that with your charitably inclined clients. Let's see. One more thing before we get to a very meaty topic. A type 2 ambit, that is an applicable multi-beneficiary trust set up by the participant for either a chronically ill or a disabled beneficiary. They are considered EDBs, eligible designated beneficiaries. And if we set up a qualified applicable multi-beneficiary trust or ambit, then that disabled or chronically ill beneficiary can still stretch distributions to that trust over their lifetime. Secure 2.0 sweetened that pot a little bit by providing that even if a charitable remainder or a charitable organization is the remainderment of that ambit, it will still qualify as an eligible designated beneficiary. So they made that clear, and that's a good thing. So if a client has a disabled child as beneficiary, they can set up a lifetime trust for that child to be the beneficiary of the IRA and provide that whatever is left on the death of that disabled child goes to charity, and they still get to stretch distributions over that disabled child's lifetime. Now, one thing that was a little bit understated in the initial publicity with Secure 2.0 is an interesting new implication for naming spouses as beneficiaries of an IRA. We all know that if you name a spouse as beneficiary outright, they can do a spousal rollover under the right circumstances and basically treat that IRA as their own, start the clock over, use the 2-life table, and recalculate their life expectancy every year. Well, under this provision in the Secure Act 2.0, in second marriages in particular, if we do a trust for a spouse, in order for that to qualify as an EDB, an eligible designated beneficiary, and get a lifetime distribution, that needs to be a conduit trust. Well, in second marriages, the spouse with the large IRA sometimes is desirous of wanting to benefit that second spouse, but also have residual benefit or partial benefit for the children of the first marriage. So if you leave the spouse outright as beneficiary, then chances are the children of the first marriage aren't going to see a dime of it. And before Secure 2.0, if we did a conduit trust for the spouse, there probably wasn't going to be much for the children of the first marriage, because basically the distribution would go to the conduit trust for the spouse's life and then immediately paid out to the spouse. So, because we only use a single life expectancy. Under this special provision, Section 327 of Secure Act 2.0, we now can elect treatment for the conduit trust beginning next year. Basically, the conduit trust will get almost all the same benefits of a spousal rollover. So what's that do for us? If the conduit trust makes this election, and I shouldn't say it that way because that's one of the disadvantages here, the spouse has to make the election. But I'll come back to that in a moment. But basically what happens is then the distributions are made under the uniform lifetime table, which involves a 2-life life expectancy. The spouse and a hypothetical second person who's 10 years younger than that spouse. So that means smaller distributions and maybe more left over for the children of the first marriage. Therein lies the rub, because why would a spouse make that election to get smaller distributions? So this is going to have to be nuanced during the estate planning process. And if you represent both spouses, as we often do, we've got to really walk our ethical line very carefully, and may in fact want to counsel them to do a post-nuptial agreement wherein you can't represent either one of them. But I still think a post-nuptial would be a great idea. And what I've done in similar circumstances before Secure 2.0 is I will have each spouse hire an independent lawyer. They will agree to waive any conflicts and engaging me to do a draft of the post-nup agreement. And then they each take that to their independent counsel to review, because I know them. I know what the objective is. So it's really more efficient if I do a draft and they each get their own independent advice from other counsel. And so here what you would want is to have the spouse who, or if they both have large IRAs, have each of them agree that if they are the survivor, they will make this election under Section 327 of 2.0 so that they will receive distributions through a conduit trust based on a 2-life life expectancy. They also get to recalculate the spouse's life expectancy annually. So the result of that is smaller distributions to the spouse for his or her life, but then perhaps a larger remainder for those children in the first marriage. The time to do it is when they're both alive and healthy. And if they both have decent sized IRAs, they both have the same considerations. They don't know whether they're going to be the first to die or the second to die. Now, let's say that planning wasn't done and now we have a first death. The chances of the surviving spouse making that election are probably 50-50, because by so electing, they're reducing their annual distributions from the plan. So it's a nice development, but there are traps within this development that really require some advanced planning. But it is a sea change if you're dealing with a blended marriage. In the past, when I dealt with a blended marriage, the options were, okay, let's maybe leave a fraction of the IRA to the spouse so he or she could roll over and get those benefits, and the other fraction to the children of the first marriage. Sometimes that works, sometimes it doesn't. The other option, which I think is less favorable, is to leave the entire IRA to the second spouse and the entirety of all the non-retirement assets to the children of the first marriage. Well, that may look really even at the time of the plan, but 6 months, 1 year, certainly 3 years later, it's going to be out of whack. So it requires more constant monitoring. So this conduit trust development, and spoiler alert, I have an article coming out that I wrote with Ed Morrow, who's a prominent ACTEC fellow in Cleveland, Ohio, that's coming out in Trust and Estates magazine in June. So watch for that. I think we do a decent job of kind of describing the statute and then highlighting the planning traps that need to be navigated to take advantage of this technique. So that's my discussion of Secure Act 2.0. And I'm now going to shift more to Secure Act. Okay, here is our first CPE code that I have to read to you. So make sure you write this down. You don't want to suffer through my presentation and get no credit, I tell you that. So the first code is the word retirement. Code number 1 is retirement. Okay, so let's go back to the good old Secure Act, now old news already. And I want to cover a couple things that deal with naming the spouse outright as beneficiary. So we all are familiar with the concept of a spousal rollover. What I've seen a lot of in my practice, I'm inheriting a situation where I didn't do the planning. And first spouse dies and the beneficiary of the IRA is the revocable trust. Or worse yet, no planning was done and the beneficiary by virtue of the plan document is the estate of the first spouse to die. We all know that's a disaster. But here's your chance to be a hero. There are numerous, hundreds if not thousands of private letter rulings that say in certain situations where a rev trust or an estate is the beneficiary, you can still get spousal rollover treatment. And so you've got a couple, you obviously need to identify the issue quickly, and you have a couple options. You can apply for your own private letter ruling, but that's not inexpensive. It costs, I don't know, $30,000 for a filing fee and probably $5,000 to have the attorney prepare the request. So it's not inexpensive. What I've had some success doing is taking these private letter rulings, and there's a more recent one that's not mentioned in my outline, and that is, take note, PLR 2022 27 0, let me start over. 2022 27005. That's the PLR. And there they basically held that because the trust that was left is for the primary benefit of the spouse, the surviving spouse is the trustee, the surviving spouse has access to unlimited access to income and principal during his or her life. The IRS has held many times that that situation should qualify for the spousal rollover. So we've had success sending copies of a few of those private letter rulings and saying to the provider, look, the IRS has been very consistent under the facts that are the same as ours that we're facing in allowing spousal rollover treatment. And we've had some providers allow that without making us spend the money to get our own private letter rulings. So keep that in mind. There are several private letter rulings like this that are cited in my handout, my outline. I will tell you that ACTEC, the American College of Trust and Estate Counsel, has requested the IRS to issue a published ruling in this area. ACTEC is not a lobbying organization, but we do from time to time issue comments, proposals for the IRS to consider. Here we didn't propose a certain ruling, we just said, give us one, you choose. But it seems that you're being very consistent on this issue. Could you please issue a published ruling we can all rely on? And, you know, in the interest of taxpayer efficiency, which they claim they're very interested in. And we first made that request in 2009, and we've made it annually ever since. And so far, we've heard zero from the IRS. But we're going to remain vigilant. We're going to be like I was in high school looking for a prom date. We're going to keep asking till somebody says yes. So stay tuned on that. In the meantime, rely on these private letter rulings, and you can be a hero if you can make lemonade out of the lemon by getting spousal rollover. Now, a quick note, so many people think when they're faced with this death of the first spouse of a couple that's a client, oh, we got to get that rolled over. Don't be in a hurry to do a rollover. There's no deadline to do a rollover. Oftentimes, it is a good idea to do it within the next year or so. But here's a couple situations where you definitely want to pause. If the surviving spouse is younger than 59 and a half, you should definitely consider delaying the rollover until he or she attains age 59 and a half. In that manner, that surviving spouse just becomes a plain old beneficiary. And if they need money out of that IRA before 59 and a half, they can receive a distribution and not be hit with a premature withdrawal penalty. So that's important. If on the other hand, they roll it over and they're 55 years old and then they take a distribution, they're going to get, it's treated as their own IRA, so they will be hit with not just the tax, but a 10% premature withdrawal penalty. Flip that, if the surviving spouse is older than the decedent, who died before age 73, their required beginning date, then the survivor can continue tax-free deferral and do a delayed rollover after the date when the decedent would have attained 73. So just to extend the deferral until the decedent would have attained their required beginning date. Okay, time is going fast. Let's talk about where the Secure Act had its greatest impact, and that is where non-spouses are named as beneficiaries. And I threw this term around earlier, and we need to refocus on it. And that is a new term, very important to us after the Secure Act, called the eligible designated beneficiaries. So if we have a non-spouse as beneficiary, that named beneficiary falls into one of now 3 categories. We have the plain old designated beneficiary we've had since 1989. we have a non-designated beneficiary, and then we have the eligible designated beneficiary, or EDB. So what are these animals? Well, the term designated beneficiary was not changed by the Secure Act. So that's been around for a while. So all individuals qualify as a DB, a designated beneficiary. Certain trusts do, which I'll cover here momentarily. But beneficiaries which are estates, charities, states, or business entities, something I've never seen, but it could happen. If they are named as a beneficiary, they do not qualify as a DB, so they would be a non-DB. We'll go over the consequences of that in a moment. The term eligible designated beneficiary was introduced by the Secure Act. So you first have to be a designated beneficiary, an individual or a certain kind of trust. And then to be an EDB, there are 5 categories: a spouse, a minor child, a disabled individual, think Social Security disability, a chronically ill individual. That's already a defined term in the Internal Revenue Code. It's one of it's fairly infamous, where it lists 6 living capabilities, like feeding yourself, clothing yourself, toileting yourself. And if you flunk 2 of those, you are deemed chronically ill. So that's the 4th type of EDB. And then the 5th type is an individual who is less than 10 years younger than the participant, like a sibling. So each of those people are an EDB. So let's talk about what that means. If the beneficiary is a DB and the participant died before their required beginning date, this is important because it's weird. If the decedent died before 73, the DB has to withdraw everything within 10 years, but they don't have to take annual distributions. They could theoretically wait till the end of the 10th year and take it all out. Or what I've had one client choose is wait till the 8th year and take some out 8th, 9th, and 10th year to spread the tax pain out a little bit. But there is no requirement of annual distributions if that decedent died before 73. If they died after 73 and we have a DB, the proposed regulations provide that both the 10-year rule apply and annual distributions must be made based on the life expectancy of the younger of the decedent, the ghost life expectancy, had he or she lived to their normal life expectancy, or the beneficiary's life expectancy. Well, that's almost always going to be lower. I mean, greater. So the lifetime is going to be greater. The age is lower. So very weird. So how does that work? So if the taxpayer died after their required beginning date, the designated beneficiary gets a 10-year rule, but they have to take annual distributions, a minimum amount each year based on his or her, the beneficiary's life expectancy. So what that will typically look like is minimum distributions for the first 9 years, and then whatever's left all has to come out by the end of the 10th year. So very confusing rule and different from if the decedent died before their required beginning date. Now, why is the EDB status coveted? It's not really coveted because for a lot of them, you have to be disabled or chronically ill. But the EDB is special because they still get the stretch. So for a spouse, the spouse outright is typically going to do a rollover. A conduit trust for a spouse qualifies as an EDB. And so we still get to do lifetime distributions. And if we make that election I just talked about after next year, we can do the uniform life table or the 2 life expectancy calculation. For a minor child, the rule is very weird. So it's a lifetime or a life expectancy distribution as long as the minor is under 21. Now, the original Secure Act had a terrible lack of definition of a minor. It didn't define it at all, left it up to state law. And in my state, it's 21 for some purposes and 18 for others. So who knew what a minor was? And then they had a rule that said if you're still pursuing a course of education, you could still be a minor till age 26. So we didn't know what the heck a minor was after the Secure Act came out. The proposed regs establish a bright line rule that it's age 21. So basically the minor can do lifetime distributions based on a very long life expectancy when they're a young kid. But then when they hit 21, a 10-year rule applies. So the rest has to come out over 10 years. So very strange for a minor. If you have a disabled or chronically ill beneficiary, they get a lifetime stretch. And then when they die, it has to come out within 10 years thereafter. If there is no designated beneficiary, if an estate is named or a non-qualifying trust is named, and the taxpayer, the decedent, died before 73, everything has to come out to that non-DB within 5 years. If the taxpayer or the decedent died after 73, then the beneficiary, the non-DB, uses the continued schedule that the decedent was using, the so-called ghost life expectancy. Okay, in the remaining 4 minutes that I have, one thing that's still important, and this comes up a lot. In fact, I just drafted one this morning, where client leaves a specific amount to charity, and then the rest to, say, their 3 children. Or let's say it's 25% to the charity and 25% to each of the participants' children. Participant dies. If that group of beneficiaries does nothing before September 30th of the year following the participant's death, they've got a problem, because we still have a charity as part of the beneficiary group, and therefore the distributions have to come out within 5 years if the decedent was under 73, or over the decedent's remaining ghost life expectancy if they died after 73. What should be done, and September 30th is the magic date. So when someone dies, here's the chronology. You have beneficiaries named on a form. So I call them named beneficiaries. But those beneficiary identities are not finally determined until September 30th of the year following the year of the participant's death. Now, Natalie Choate is the undisputed, undefeated expert in this area. And she calls that September 30th date the beneficiary finalization date. Well, we like acronyms, and that comes out as BFD. So I call it the beneficiary determination date. So what we want to do in my hypothetical is we want to cash out that charity before September 30th. Because then when September 30th rolls around, who's left? The 3 children. And they then get to take advantage of at least 10 years. And if, God forbid, one of them is disabled or chronically ill, they get a lifetime stretch. But we've got to get that charity out of the mix. So that's very important. I have a whole section of my outline, leaving retirement assets to trust. And I'm going to spend 5 minutes kind of summarizing that before we open it up for questions. But first, I got to give you CPE code number 2, and that is Kirkland, Kirkland. No, I don't own Costco's Kirkland. I wish I did. I wouldn't be doing this for a living. But in any event, Kirkland, that's your code number 2. Okay. Leaving trusts as beneficiaries requires expert drafting, because only certain trusts qualify as a beneficiary as a designated beneficiary of an IRA. There are two kinds that qualify. One is a conduit trust. Conduit trust basically says, trustee, take out the minimum distribution required from that IRA and immediately pay it out to the named beneficiary. A conduit trust for a spouse is a possible good technique in a second marriage, but you got to watch this election under Secure Act 2.0. Conduit trust for minors is a possible technique. The other type of trust that qualifies is a so-called see-through trust or accumulation trust. They're both called see-through trust, but an accumulation trust. Now, here, there are 5 tests to qualify as a designated beneficiary. First, the trust must be valid under state law. Well, if you don't meet that, you got lots of problems. Second, the trust must be irrevocable or become irrevocable upon the participant's death. Third, the trust beneficiaries must be identifiable. Fourth, certain documentation, namely a copy of the trust, must be provided to the plan administrator or IRA custodian by October 31. Couldn't they make these dates all the same? By October 31 of the year following the participant's death. So those are fairly easy to meet. The 5th requirement is the tough one. The 5th requirement is that all trust beneficiaries must be individuals. And therein lies the time-honored dilemma when we're drafting see-through trust. What trust beneficiaries count for these purposes? So the current regulations are not terribly helpful. They basically tell us that a contingent beneficiary must be counted, but we can ignore a mere potential successor. They don't bother to define either of those terms. So we're left to our own guessing. And even the proposed regulations made a better attempt, but still leave a lot to be desired. So if we have a trust for child's life, remainder to child's children, but those are still kept in trust for those grandchildren's lives, and then on to the next generation, where do we stop counting? Unfortunately, we don't really know. And so that's a problem with drafting these trusts. So I've had some situations where I've had a long-term dynasty trust for non-retirement assets, but a trust that terminates sooner to be the receptacle for the IRA. But watch that development. We've made, the ACTEC group has made several comments in attempting the IRS to give more definition, put more flesh on the bone in terms of defining these accumulation trusts so we can draft a little more safely. I see the virtual hook has come out on my picture here. So I will stop babbling for a moment and open it up for questions. I think Kathleen's kind enough to moderate those. Before, though, the all-important CPE code, number 3, and it is secure. You're probably feeling anything but after this presentation, but the code is secure. I make fun, you'll notice the title of my outline, I make fun of the name they gave this, the Secure Act. It's anything, I felt so insecure after I read it. It was terrible. All right, Kathleen, what you got for me?
Well, we've got a lot of questions, Bob, so I'll start at the beginning.
You must be
Are plan sponsors required to offer Roth, simple, and SEP accounts, or is that optional?
I still can't hear you, sorry.
Can you hear me now? Let's try that again. Can you hear me now? No?
No. Maybe a couple of our administrators could fix it.
Yeah, we can hear Kathleen.
Can you hear me?
Yes.
Okay. So Bob can't hear me. Shannon, do you want to ask Bob the questions?
Yes, Bob. So you can hear me, Bob? Bob?
Shannon, I can't hear you either.
Okay, so it's not just me.
Hmm.
If Bob can look in the
Uh,
text box.
Maybe there's a way to post those and I could read them myself and answer them.
Mhm.
Is there a way you can show those on the screen?
Yes, I just sent that to Bob.
Okay. What do I? How do I access those?
All right, I'll send him a chat, see if you can see that.
Try again, Kathleen.
Can you hear me now?
Yes.
Here we go. It's magical. Okay, so I'm going to go back to the first question, which was, do plan sponsors have to offer Roth, simple, and SEP plans, or is that optional?
Oh, they don't have to offer them. It depends on their particular plan document. So,
Thank you.
yeah. Okay.
With Coverdale ESAs, do they have the option for the one-time rollover to a Roth?
They are not. That's a great question. They are not specifically named like 529 is. So I think the answer is no for now. That's something that would be nice to lobby for because it's a similar situation.
Absolutely. So here's one. How should I designate? My client has all minor beneficiaries. How should I designate her retirement plans to pass when she dies?
Well, that's an excellent question. And when Secure Act in 2020 first came out, planning for minors was a mess because first of all, we didn't know what a minor was. And secondly, your options were pretty limited because our historical or traditional minors trusts did not work. And what I mean by that is it's typical for my young client parents to set up a trust as if my children are under age 30 or 35, their share will go into trust till they reach that age. So the issue then is if those trusts are beneficiaries of an IRA, even though their primary beneficiary is a minor, do they qualify for the stretch? And the answer is no, because you have to count the remainder beneficiary, which may very well include non-minors. So the typical minors trust did not work. So then your option was either a conduit trust, which isn't perfect because that requires an annual distribution. And who receives that on behalf of the minor? Do you have to get a court-ordered conservator appointed? Could you appoint in the designation a custodian? That was unknown. The other option was just to name a custodian as the recipient for the minor, but then what if the custodian dies? Custodians are typically individuals. So the good news is the proposed regs really came to the rescue here, and without any statutory authority, but they developed a concept called the age 31 trust. And the proposed regs say if your trust that will receive the IRA for the minor either terminates on the death of the minor, if that happens first, or when the minor turns 31, i.e. 10 years after age 21, then you will qualify as an eligible designated beneficiary and can use the life expectancy distribution schedule until 21 and then pay it out over the next 10 years. And it doesn't matter who your remainder beneficiaries are. In fact, they could be charities, and the age 31 trust will still qualify as an EDB. Long answer to your question, but that really helped me get to a part that I didn't have time for here in my presentation. So.
Thank you. Can I ask one clarifying question there?
Sure, I hope I can be clearer.
You said that the trust terminates at the death of the beneficiary or 31.
Yeah, so really the sooner of. the sooner of those two. So
So if the trust says, if the beneficiary dies, the assets in the trust go to their descendants. If they have any, that would not qualify.
it would qualify. That's the beauty of it. It's a safe harbor that automatically qualifies as the EDB, even if
Okay.
there's a possibility it will go to other beneficiaries like siblings who are not minors. It still qualifies as an EDB. And so if the minor dies before 31, it has to all come out within that period. That's 10 years after the minor turned 21. So they get EDB treatment as long as, until the 31st year is up.
Thank you for that clarification. This is really an opinion question, but I'm going to ask it anyway. One of our listeners said, is it a good idea to name the living trust as a beneficiary of a retirement account?
That is a great question. And I would say before the Secure Act to never do that. What I've done historically is I use an attachment and, fought that battle for years. Now they're a little more commonplace and they're more acceptable. And the attachment says, if my spouse doesn't survive me, or if they're single, split these benefits equally amongst the children or the descendants of a deceased child, but send each of those distributive shares to the share of my revocable trust set aside for that descendant. So it accomplishes the same thing, a little more nuanced. We're not naming the Rev Trust, we're naming each of the sub-trusts directly. That was critical before the Secure Act. The Secure Act bails us out in certain situations where we name a Rev Trust. Let me give you an example. If we name the Rev Trust, and the Rev Trust provides that effective immediately upon death, it splits into equal shares for children, and one of those is disabled or chronically ill, we can still get EDB treatment because of the AMBIT 1 and AMBIT 2 rules if we qualify. So there you're kind of bailed out. Here's a situation where you aren't. You name a Rev Trust, and the Rev Trust provides that it's split, maybe let's just say 50-50 between a conduit trust, a Q-tip trust for the spouse, and then a trust for the children. There's an open question as to whether that conduit trust will qualify for EDB treatment. What you should do instead in that situation is use the attachment. 50% goes directly to the Q-tip trust, 50% goes to the share for the children, and not name the Rev Trust as the beneficiary. I inherit a lot of situations where the Rev Trust is named, and fortunately we do. Sorry, voice cracked. Fortunately, I get really emotional about this. No, we've done some post-mortem modifications to still achieve the result that we want, but we have to act fast. So we got to get that done before that magic date, September 30th of the year following the participant's death. So be careful. Short answer, be careful naming. I still like my approach of splitting it at the beneficiary level and then sending it to the individual subtrust.
Well, Bob, thank you so much. We've got a couple other questions that we'll send you offline, but we really appreciate you joining us today. And I believe there is a slide of each of the 3 CPE codes somewhere along the line. If you missed them, let us know. So, Bob, have a great rest of the day, and we really appreciate your time.
Glad to do it. Best of luck to all of you. Happy planning. Thank you.
I just want to remind everybody that Bob's presentation is available, both in the PDF, which is in the presentation, and also on the link that you received with the instructions to sign in today. So now I believe we are going on to our next presenter. Jamie, are you there?
I am here. How are you?
Hi, Jamie. How are you?
I'm good. Yeah. Looking at lighting's a little dark in here today, but otherwise pretty good. Yeah.
Well, thank you so much for taking the time to join us today. We really appreciate it.
Yeah, well, thank you. And, you know, it's one of those ones, though, right now, it's like I should have sat in here for the whole one before me, being that I was like, I would have, you know, I hope maybe you can be a little bit of help too, just on the guidance on what was covered, what wasn't on that one. But because what I don't want to do is spend an hour with everybody covering things that was already talked about. So, but we'll
So Jamie, let me just take a minute to introduce you, because there are actually some people out there who probably don't know you. So for those of you who don't know Jamie, I'd like to introduce our second presenter, Jamie Hopkins. Jamie is an attorney, MBA, CFP. He has an LLM. He's a CLU, ChFC, and RICP. He's the managing partner of Wealth Solutions at Carson Group. He also serves as finance professor of practice at Creighton University's Heider College of Business, or is it Heider? Heider College of Business.
Yep.
Heider. And is president of Financial FinServe Foundation. As a nationally recognized writer and researcher, Jamie is a regular contributor to Forbes and Kiplinger. He's a highly sought after speaker in the financial services industry and has been featured on in the Wall Street Journal, Barron's, CNBC, and U.S. News and World Report. And we are very happy to have Jamie joining us today. Jamie, I'll turn it over to you.
Well, thank you. It's great to see everybody, and thanks for having me on. Let me give a second here and make sure I get slides up. It looks like you want me to share them from my side, which is totally good. So we'll see which screen pulls up first, but it should be here in a second. They're up. Show my screen. And then we might just have to swap screens. And how's that? Looks like they're up.
Looks good.
That's a good start. We have slides, I'm here, everyone else is here. Well, thank you for the introduction. I really appreciate that. And, you know, so I have, you know, probably a little bit of a tie-in to some of the stuff that was just covered, really focusing on the Secure Act 2.0. And, you know, I'll try to dive into some planning areas that I'm super excited about right now. If you download the PDF, which I know is available, it's a really nice add-on to the last one too, because you've got a lot of the written content and a slide deck. And, you know, I've kind of approached this, I probably do one of these almost every week right now. And they are really fun for me because you're constantly learning when you're thinking about this new bill. You know, there isn't, you know, we don't have all the information yet. And so one of the ways that I like to approach it when I'm talking to advisors and, you know, financial service professionals is like, let's start kind of strategizing, thinking through things that might come, you know, down the line, et cetera. And I'll kind of focus more on the income side, you know, as opposed to the estate side here. So that'll be a little bit different of an approach. But I think the questions are open in there too. But if you have questions or you say, hey, like we already heard a lot about this, I'll keep that part open here on my screen so I could hop into it and shift to something else. I think there's 78 slides in this one. And for the most part, I've been trying to not stay super slide heavy, but I'll start with a little bit of kind of my story around the Secure Act and Secure Act 2.0 at the start. Doesn't have to be your story, but it's a little bit of my perspective. So I'll hop into that. We'll save 10 minutes for the end for questions too. But by all means, honestly, if you ask questions and I hop into those, it makes for a lot more fun anyways. So I can dance around wherever we want to. I appreciate the overview. I usually drop a couple other things in here. I'm managing partner of Wealth Solutions at Carson. And so I'm sitting here in Omaha, Nebraska today, and we're out here for our partner summit. So we got about 400 advisors out here, and I'll be doing some tax planning later this week with a lot of them too. I also am a father of 3 young children, which I love. It's one of my favorite things in life, and I'll talk about that at least in some of the 529 parts of this, which is it's changed my own personal planning around that since this law has come out. At least my mindset around, how I'm going to leverage 529s, what the right number is for me, which might not be the same approach that everybody else takes. I have a wonderful wife who's also in our profession. She works for UCLI, which is Berkshire's insurance company. So kind of a family of attorneys, young children, and financial service professionals. So super excited to be here. The way that I kind of break this presentation out is I kind of look at, what I'll look at is kind of like planning categories out there for us. So I've laid out 6 over here. It's not the only 6 that fall into this bill by any means, but expanded savings opportunities, and how can you take these opportunities exist, whether real or not, for clients, use it to enhance their, their planning, use it to modify behavior, which is always a super important part of what we're doing in the advice world, or prospect, right? Like you can use these across all of those different domains. Understanding the rules is one thing, but how do we put them into practice? How do we actually engage with clients? What's our messaging? What's our story? I think that's just as important as anything else. So I'll talk a little bit about that expanded savings. Like that one's really exciting for me. The college loans and education part, which was really interesting because that was very much a policy decision that we couldn't get other bills passed. So we reverted to putting some of those provisions here inside of Secure 2.0. Emergency funds being a really interesting policy decision that was made here, backed by a lot of behavioral finance and just general finance research about how important that is to really help the kind of core of Americans that fall behind on their expenses. The Roth changes, annuity changes to distribution, retirement income planning strategies that come out of that area. So I'm going to do a little bit of my history and story part here, which is we'll actually start with the original Secure Act. And you go back to 2019, which now just feels like forever ago, right? Like we're talking about the before days and how different the world was. And, I think we're starting to get back to, how we were operating. But when this passed at the end of 2019, I looked out and I thought, you know what, the rest of my year is going to be, 2020. It's going to be me going around and talking about the Secure Act to clients and advisors, webinars. Now, I did a lot of that. I did a ton of it in the first couple months, right? January, February, and the first 2 weeks of March. And then all of a sudden that March 13th hit, and that was the day, at least for me, kind of world shut down. And I didn't get to go out and talk about this a lot. And most of us are aware of these rules, and we still have the proposed regs, which are modifying some of this, but it was a really big bill. But I hit on the first part here, which when I really look back at the Secure Act, it was a stealth tax bill. Now, we don't have to dive into that too much, but 90% of the tax impact came from the one provision, the 10-year, RMD changes in there, essentially shortened down a period of time in which we had tax deferred growth, and also pushed out those distributions, right, at a time period in which the people, in general, who are going to receive those distributions are going to be in higher earning years than the people who had deferred this money out and had owned it before. And even the stretch aspect kind of let you stretch those out into later years in your life. So because of that, we actually saw this like bubbling tax bill that's going to occur because of that. But really interesting, if you look at the actual congressional report about the budget of the Secure Act, it essentially says, hey, look, this thing is almost revenue neutral. It does indicate that it's revenue positive, that the total Secure Act was revenue positive, but pretty much neutral. But the interesting part is that they, the way the Congressional Budget Office looks is they look at 10-year slices. So what happened? The impact of this bill essentially fell at year 11, right? Pass it in 2019, year after the date of death, you got the 10 years, so you fall right outside of really the tax bill piece. But this was a, in all honesty, a stealth tax increase bill with some common sense changes. Now, fast forward to the bill we had passed this past winter, the Secure 2.0 Act, and I'm glad they finally just changed the name because that's what we were referring to it anyway. So everybody just said, look, you stop calling it the Secure Act, we'll just name it the Secure Act, be done with it. But if you look at this one, again, Secure Act 2.0, relatively budget neutral, but I would say is actually a much better retirement bill than the first Secure Act. The reason that that's good news is because what happened in 2020, we didn't get to work on the planning. We didn't get the messages out to consumers. We didn't get to do what we should have been able to do after that first bill passed. What this is really allowing us to do from a messaging and planning standpoint is to pull both bills together from 2019 and 2022 and kind of treat it as one continuous change and go to clients who hadn't made those changes over the past couple of years, to the attorneys that haven't made the changes, to the estate plans that haven't made the changes, and say, look, we need to get an action to continue to update this. There is a reason, besides me telling you, right, that we need to make changes because we have a bill that just got passed and some of these things are phasing in right now. So I view this as a huge opportunity for us to kind of right some of the wrongs that eventually happened after the Secure Act was passed because we didn't get the face time, we didn't get the voice time that we needed after the first bill. And if you go back, wait, what happened? The CARES Act passed and COVID, and we just got spread out on other things. So let's hop over here. And obviously a lot of the details you can look up either in the later parts of the slides or even in some of the written materials are really great on this. So I'm going to try to focus today on where I see the opportunities being here for us to have an impact, whether you are an advisor, you're working with an advisor, you're working with a financial service professional or are one. How do you bring this to the table and actually drive some meaningful action? Because if we can't drive meaningful action, all right, we just, one of my favorite sayings about education that I use a lot is, right, education without execution is just smarter people doing the same dumb things. So really after this, we want to be able to execute and drive some type of behavior change impact at the client level. So I put 4 different groupings of savings opportunities that came out of Secure 2.0. So the first one is the starter 401k. Starter 401k, in essence, being IRA contribution limits, no employer contributions, very cheap, simple way to set up some type of savings vehicle at your employer. And what is that one really targeted at? It's targeted at the small employers that have continuously struggled to get plans in place. And what we know from research is when you have an employer plan in place, you save more money for retirement regardless of your income. But we have struggled from a policies perspective without mandating these to get people to adopt them. So that's been a continuous challenge. Now, when I look at that one, are those really appealing plans? My general standpoint is no. A lot of the plan providers, a lot of the other experts and thought leaders I know out there in the retirement space, they're not super buzzed about these. I mean, great, but we could kind of get to this outcome already. It is a little bit of a change, but not, I don't think that this one is going to really fundamentally shape how we move forward. But it is a new change. We will see some of them pop up here over the next couple of years. The Savers credit, moving to a Savers match, is a huge change. We are going from a tax credit that you kind of get back and can go spend to a match into your retirement account, so your IRA, for making that retirement savings contribution. From a public policy standpoint, I love this provision. The idea is we're going to encourage you to save money for retirement by putting money into your retirement plan, just like we have with matching contributions historically, which has worked really well in the ERISA world, that matching contributions drive behavior. So this is a really interesting policy piece. I really love it, except for asterisk. It is probably the most convoluted part of this bill if you start diving into this. All of the pullback provisions are incredibly complex. Now, for a lot of you, this is not our core clientele group based off the income and the phase out for the Savers credit and match, but this is a really important one. And the IRS and the government for the last probably 5 years has really focused on this because we don't see enough people taking advantage of this. So we have an underutilization of a really powerful credit now match moving forward that just isn't getting the attention it needs. So there's also some set aside of funds to kind of promote this more, get education out, try to drive this change in behavior of saving for retirement. But the scary part about this one is, do all these other restrictions about if you take the money out, the government could claw it back and penalty taxes, all of that being added onto here, is that so complicated that it drives away the behavior change that they are actually looking for here? So I think the matching part, really nice, interesting policy. All of the additional clawback provisions, kind of odd for me, because when I look at those, we had a credit before that you could just kind of spend. And if you could just spend that, why are we so concerned about clawing this money back? Just leave the additional rules that are already there in place to deal with it. The penalty taxes, ordinary income taxes versus clawback. I think they went a little bit too far on this one and probably put some hurdles for broader adoption. Expanded automatic enrollment, super interesting one again. We know that that has worked from a policy perspective, but huge exceptions here. Basically, every plan in existence, already in existence, exempted out. Small startup plans exempted out moving forward for a period of time. And so most plans that start today already have automatic enrollment in them. This will not be a major change for the industry. It's a nice soundbite, I would say. It's not a huge impact. The vast majority of plans have automatic enrollment built in. I do like that we are mandating it long term, but look, there's still nice carve outs there for small employers to keep costs down. So there are some things to do there. Now, the last one here, while if you look at this from a dollar cents perspective, from a policy perspective, is probably the least important one of the 4 expanded savings opportunities. For the advisor world, financial service provider world, I would argue is actually the best one for us. Why? This is essentially doubling of the small business retirement plan setup tax benefits that was created in the Secure Act for certain types of small businesses, essentially doubling that credit that we would get for these startup administration costs. Why is this such a powerful planning vehicle? Because it goes back to the story I told you before, is that why don't people, well, it goes back to 2 parts. One is it's dealing with a mental hurdle that many consumers have, many business owners have about setting up retirement plans. And if one of our goals is to get more money into these plans so people are actually saving for their future, this is one way we can actually tackle that. The idea is, right, we're trying to remove the startup costs. So the costs of running a plan are not your hurdle point. Well, we didn't remove fully the complexity piece, but maybe we limited it down. It's not as complex as it once was. And now we've added, right, really a cost reduction mechanism here. It is not the actual cost and the credits to me that are super important. Yes, they're valuable, but that's not the important part. The important part here is that this arms advisors and financial service professionals with the ability to go into clients, into prospect clients, to small business owners that don't have retirement plans set up and say the government has reduced down the cost to setting up a plan. So if you had looked at one before, you thought about one, and you felt that it was too expensive, the costs are reduced. We didn't get to do that a ton after Secure Act, and now we get to do it with an even better version. And even if you did get that conversation once after the Secure Act, we have now doubled that cost savings potentially for you. And so this, to me, really becomes an opportunity to prospect and help small business owners set up retirement plans, because it is a way to approach one of the biggest hurdles, right? Complexity is a hurdle. We don't need it. And the cost, and it does allow you to address that and get open eyes on it. This was working right at the beginning of 2020. Honestly, I did this with a bunch of prospective clients out there, and I also did a similar thing right after Tax Cut and Job Act passed with 199 Cap A deduction planning and retirement planning to kind of show the tax savings you could drive. That one was even more powerful. The dollar amounts were bigger, but the conversation can start there. So super interesting part for me. As you start to think about how do you build materials, what are your talking points, that's one that I would focus on if you're in the retirement business space. So let's go over to the next one here and kind of talk through a couple of these and where I think some of the kind of the interesting points are. And maybe I'll just hop over that one and try to go through some of the other stuff a little bit faster. So increasing the RMD age, moving out to 73, eventually to 75. We're at 73 now for this year. Look, ultimately for people who don't need to take out their RMDs, this is a slight benefit in most situations. Now, you don't always want to push off RMDs forever. There are some analyses you can do there. It shows that the tax implications of pushing off too long, you're actually kind of ballooning payments, you're condensing to a shorter period of time, you can actually raise taxes on it and reduce your total asset level. So you might still want to take RMDs out. Generally speaking, not a lot of people do not need to take out at least their RMDs at age 73. There used to be a stat at 70 and a half from the IRS around that. And, the vast majority of people, I think it's like 88% or 92% had to take out at least their RMDs at age 70.5, that number is even lower at 73. At 75, it'll be an infinitesimally small group of people that are really wealth building at that point. So good for a lot of our clients, opens up optionality and planning to do conversions for a longer period of time, and recognizes that people are living longer and longer. IRA catch-up limitation, if you look at this bill in total, a lot of inflation adjustment changes in here. Inflation's a big topic. You see that pulled through into the bill. Higher catch-up limits for age 60 to 63, essentially doubling the catch-up contributions at that point. Kind of two interesting things occurred there. One is those are going to go into Roth accounts, which I have on a different slide. And then two, I've had this conversation for years now, and actually I think going back to 2012, I've been kind of opposed to this aspect of planning, and I'll give you my theory on it. And again, you can have your own view, but give you a countervailing theory on whether or not this is a good policy or good planning from an advisor, and I'll give you my tilt on it. I find it super interesting that they opened it up for such a narrow period of time. But if you look at who is falling into this group, tends to be probably people making over $250,000, $300,000 a year at that point of time to be able to max out their salary deferral and max out their catch-up and now be able to double it. You're talking about mostly high earners, probably fall into high tax brackets, being that it's going into Roth accounts now too, probably being taxed at a high rate at that point. Might not be the best strategy actually to do that. Might be, might not be, but at least it's like some, points of data to pay attention to. Now, here's the behavioral part that I find super interesting about this. If we look at how people behave right around retirement, any of you that are client facing have probably felt this and had this conversation before, is, well, I'm getting ready for retirement, so I'm really going to buckle down. We're cutting expenses, increasing savings, cutting expenses, increasing savings, savings, because I want to get ready for retirement. Totally normal. You've been preached that your entire life as a client, as an investor in this country. Well, is saving an extra $15,000, an extra $10,000, the 4 years prior to your retirement, the best strategy? Well, that's really debatable, because if I take that money and I give myself permission to not spend or not save an extra $10,000 a year for 4 years, $40,000. Did $40,000 of additional savings change my retirement, kind of outcome substantially? For most of our clients, and for most of those people earning $250,000, $300,000 a year at that point in time, or the people that are able to do that, $40,000 is likely not to have a massively transformative impact on their retirement income sustainability. It might have an impact. I'm not going to say it has zero impact, but it's probably not the biggest thing. So instead, and I've done this with a bunch of our clients here at Carson Wealth, which is, should we spend that money instead? Should you take that money, invest it back in your own well-being and health, in the sense of take a nicer vacation, go away for a week. And if you do that for 4 years, can you work 6 months longer? Can you work a year longer? Well, if you're making $300,000 a year and you can work 6 months longer because you spent an extra 40 grand to go on two, or maybe it's just two really nice vacations the year before, and now you can work 6 months longer. Guess what happens to your portfolio? You are significantly better off by spending that money and working 6 more months than you would be to save that extra $40,000. So behaviorally, and as we look at clients, we have to challenge that, because what I will tell you is I look at this industry and the planning opportunities out there over and over again, and that to me is a huge mistake we continuously make, and we allow clients to make, is we buckle down, we tighten expenses, we increase savings. The government policies allow for this. The new bill even increases it and tells you essentially that you should do it. But when you look at the actual portfolio and planning opportunities, that might not be the best situation. So interesting thing, at least a challenge point to look at clients and say, should we actually reduce spending nearing retirement, or reduce savings and increase spending? It feels counterintuitive, but if we can keep somebody in the workforce 6 months more, it is significantly better. A couple other things here, pretty quick to roll through. Retirement plan sign-up incentives, thinking de minimis credit cards you hand out, people can show up, and those have a lot of behavior modification too. People show up for the $20, $15, Uber credit cards and things like that. So we'll actually probably see a slight impact on retirement plan signups due to that. Increase the amount that employers can put into simple plans. That's a nice change, allowing a little bit more savings there. reduction in the missed RMD penalty tax. One of the more interesting long-term ones to study out of this. I have my assumption on what's going to happen here. So let's talk through this one real quick. Today, as probably most people here are aware, this is a very smart group of people. I've interacted with many of you in person. We're well versed. And what we know is that a missed RMD penalty tax, right, is 50%. It's really onerous. It's scary. People do not want to miss their RMDs because of this. A lot of people, consumers, know this tax, and they can't name 5 other taxes, but they know this one. It's a scary tax. It doesn't mean that we don't run into clients who miss their RMDs, but it is a scary tax and people are aware of it because it is so onerous. I mean, 50%, there are very few other taxes we can even think of. I mean, you can have people that just engage in straight up fraud and abuse and don't even get hit with 50% penalty taxes, right? Like, think about that. Like, there are so many other areas of the world where you don't get hit with a 50% penalty tax, but just forgetting about your RMDs for a year is 50% penalty tax. And so what has happened? The IRS said, hey, look, if you fix this and let us know and you don't pay that penalty tax, in essence, we never really come after you. In the now 17 years of me doing this, I have run into one person that I know of who had a client who the IRS actually came back to them for the missed RMD penalty tax if they reported it and didn't pay it. I know of one. I know lots of advisors who have gone through that process, reported it, fixed it, and they never heard anything back. Now here, the government's saying, look, we're going to cut that in half. And if you even fix it, we're going to make it even lower. Well, 25%, well, that doesn't feel as onerous. In fact, that might be reasonable enough to apply to somebody. We might be able to live through this negative PR hit because if you think about, do we really want the news cycle to be talking about the IRS and applying 50% penalty taxes to 78-year-old Mrs. Jones because she missed 1 year of RMDs? That's not great press. And I know you're thinking, well, does the IRS really care? They care a little bit, right? I mean, they don't care as much as a public company does, but they still care. They think about how they're viewed in the press. They go after certain individuals to make examples of them, and that's not really the story that they wanted to tell. And if you're also looking at the budget from the Biden administration, what have they said? And this actually was true in the Obama administration too, which is we need the IRS to enforce more of our existing tax laws because we're missing a lot of tax revenue. So we can increase our tax revenue long-term for the budget by just simply applying the existing laws and rules that are in place today. So we have this huge opportunity as the government side to increase tax revenue without any tax increases, just by simply enforcing them. Now you see this rule, very, very interesting because now we have a lower penalty tax. So if we agree that penalty taxes, which everybody might not agree with, but if we agree with the assumption that a higher penalty tax discourages people from acting that way, right? Like 100% penalty tax, people aren't going to do it. A 1% penalty tax, people are probably more likely to do it. I think we have some agreement on that. So is 50 to 25 or something like that enough of a change that behavior occurs? I think it is. I think a halving of it could change some behavior that we're not as worried about it. And then if you fix it, it's even less. So we might have more people than ever before start to miss their RMDs because the penalty tax isn't as big of a fear factor. Not only that, we're finally going to have what I truly believe is the IRS. If you read this bill, the IRS is getting ready to enforce this, and they haven't before. So we are going to start seeing RMD penalty tax applied. Now, why do I think that's such an important deal? I mean, one, it's less money for our clients, but two, the risk factor around this for advisors and advice around RMDs is going to increase after this bill. It's going to increase to a level that we haven't seen because, look, there's going to be lawsuits about it. There's going to be E&O about it. And we haven't really seen that before because often we could fix this. We could pull the money out and not get hit by this penalty tax. And for everybody who's worked with custodians and BDs and other providers, there's already been a skittishness about calculating the RMDs. So if an advisor is actually taking that on, a financial service professional, and they get it wrong, and there is now a penalty tax applied, it's a very interesting situation because before we just didn't worry about it all that much. The IRS didn't come after this a whole lot. So that to me is going to add a whole nother layer of complexity onto this type of planning and a little bit more risk onto the financial service person providing this advice. So higher, really we're going to see more people miss this, more times applied, and a little bit more risk on the advisor world. So very interesting way to approach this. And I know most people looked at this, and when I first looked at it, I had the same feeling. I was like, that's great, wonderful. They're going to reduce that down. And then I started going through my actual life experience on it. I said, wow, this might not actually be a great thing. So that'll be really, really interesting to follow over the next couple years. And the last one here, great policy change. Really big fan of this. So no more required minimum distributions for Roth accounts pre-death of the owner. So Roth 401k, Roth 403b, those used to be subject to the RMD rules while you were alive. And we had a workaround. We rolled them over to a Roth IRA, and it just added extra work. So wrapping that on here, really, really great policy change. I went about 30 minutes. I probably should have gotten here a little bit sooner, but we'll hit that CPE code number 4 here, which is client, C-L-I-E-N-T. Going again for CPE code number 4, C-L-I-E-N-T, client. So I'll give another second here, and then we will hop back to something else. We got 3 of these codes throughout my presentation. So I know that was a lot of information right there. Anything, in the chat or otherwise, don't see anything in the questions. So everybody's just cruising along with me here today. But if you have any questions, thoughts, comments, different views, let them fly. Now, I saw the pre materials here in the last section. I don't know how much you guys went into the 529 to Roth rollover. Interestingly enough, I find it to be, it's probably the most interesting provision out of this entire bill from a financial advisor, service professional standpoint. But it also has like probably the most amount of questions I still have open. Where are we going to land on this? So I'll start with the bottom one, and then we will spend a little bit of time here in this 529 one because I believe it's a super big opportunity for us to do wealth transfer, to do college education planning, and tax planning. So it really falls into all 3 categories. Student loan repayment match. Now, probably a lot of us are aware that there were some private letter rulings out there before that allowed for this from some qualified plans. They've essentially codified this and said, look, you can allow a participant of your plan to make qualified student loan repayments, let you know that they have made those, and do a match into your 401k for that qualified student loan repayment. And this is really a policy thing. It is, we have a young generation of people coming into the workforce straddled with student loan debt, that their cash flow is going to student loans. We haven't been able to come up with a better forgiveness program, any of those things, so we are where we are. And then that person that's straddled with student loan, they can't save for retirement because all their cash flow is going over here. And one of the best benefits that your company might offer is the match. So now this person who is already a little bit maybe behind some counterparts because they're straddled with student loan debt and this cash outflow can't save their own money and are missing out on the company match. So this kind of allows us to at least give the match for, look, you're doing something wise with your money. You're paying down your debt. We're going to allow that match to come in here. Essentially, the rules say you got to follow the other matching procedures. You can't have different rules for these two. Nice provision. Excited to see that in play. Now, let's go to the 529 one. Super fun, right? Everybody else is excited about this as I am. So this one is so interesting. And it will be, I'll put the caveat or the asterisk on this one right as we start. The thing about this one is the devil is going to be in the details of the proposed regs and then eventual regs that we get around this. The bill as it's drafted is pretty broad, my friends. It is wide. It can offer a lot of opportunities. But what we could see happen here is that regulations come in and go, shoo. It doesn't eliminate the value of this, but it could take it from being, I don't want to call it a loophole, but it could go from being a really big planning and wealth transfer vehicle to kind of probably what it was intended for. So that range is broad right now. So what does it essentially say? It says $35,000 can go from your 529 to a beneficiary of that 529 in Roth rollovers. And I should say rollovers with an S because you can't do it in 1 year. And I think that's really important to recognize is the amount that you can roll over each year is going to be capped by the annual IRA contribution limits for that year. So I'm just going to use 7,000 for simplicity as I talk here today. So we, if we have 35,000 we want to do over time, we got to do that at $7,000 clips. So that's going to take us 5 years to be able to do that. So we're not going to be able to do it all in 1 year. But where does the what was the purpose of this provision, and where is the planning opportunities? So let's start with the purpose. The idea here was, we went back to the other one. People are being straddled with student loan debt. We want to encourage people to save for college planning. 529s are one of the vehicles that we have out there for that. I use a 529 today, and I'll get into how this has changed my perception a little bit. It's probably my single favorite financial memory that I have to date. I was in Vegas, I was speaking at a conference, and instead of going out and gambling, I'm not a big gambler, I should say, I don't gamble at all. And I went back to my room and I opened up my 529 accounts for, I think at that time, 2 of my kids. I didn't have or maybe just one of my kids, Rebecca. And I opened up the first 529 and put some money in there that day. And I felt super proud of that, right? Like, look, I am, I just had 1 kid at that point. It's just my daughter. And I opened up the account and put money in. And I had spent about 5 months researching all the different 529 accounts out there. And the way I live in Pennsylvania, the way it works is you can actually use any state's 529 and still get the state income tax deduction. So very flexible rules there. And felt super proud about that. And my theory had been, I want to fund about half of their college education expenditures through a 529. So not everything. And that's just, there's different planning techniques around that. Do you want to use trusts, and how do you want to do it? But my general thematic has been half. There's nothing super magical about that. It's something I felt comfortable with, and that's the way I've been approaching it. So one of the challenges, though, when you approach something like that is, well, what happens if I overfund it? And that's what a lot of clients worry about. Well, what if my kids don't go to college? What if the college funding rules just change in the future and colleges become free? What happens if they get scholarships because they're really smart? What if my kid's the best athlete ever, they go to 1 year and they get NIL now and they don't need money for college? Okay, those are all reasonable things. Now, the grand scheme of the world, they're probably not 90% of the time they're going to occur. That's more of the 10% rule. But look, those are reasonable concerns. So to offset this concern, the government says, well, let's allow people to use the money in some other fashion, because today, if the money goes into the 529, you can't use it. The tax implications of pulling the money out later are pretty onerous. It's not great. So we're going to allow this money to move to a Roth, because that's tax-free as a 529 if used for qualified education expenses would be tax-free. So we're kind of getting that tax-free growth here in either account. So that makes sense. The general thematic was, let's remove a hurdle that is at least a hurdle for people to save into 529s. Now, look, who is this mostly going to impact? Wealthier clients, high income, can save a lot of money, grandparents or parents of kids funding a college future. It's not impacting probably, middle America and, our lowest income earners in the country, but a lot of financial planning, financial service clients will fall into this category. What becomes really fun about this is it starts to look like a wealth transfer vehicle that we could start putting money into a 529. And for, say, in Pennsylvania, I can get my state income tax deduction on it. Well, some states, 10%. State income tax, so all of a sudden I can start offsetting, I put $35,000 in, I get $3,500, state income tax deduction. Well, that's pretty good. Do you know what I don't get a state income tax deduction for? My Roth contributions. Now, I'm not sure that in this case, the juice is worth the squeeze, but it's still interesting. Let's say you are in a state with 10% state income tax, and you do get a deduction here for 529. In fact, a better way to fund some of your future Roth expenses might be to fund the 529 with yourself as the beneficiary 15 years later And that'll be an interesting time period about the, when do they start tracking, and the proposed regs will probably handle that a little bit. And that one might change a lot of the planning opportunities, but set up a 529, be the beneficiary for yourself, roll the money over 15 years later for the next 5 years into a Roth account. And essentially what we were able to do is get a state income tax deduction of the 10%, right? That we otherwise couldn't have got with a Roth. So that's actually, $3,500 we get to save. Now, is that worth setting it up and waiting 15 years and doing it over 5 years? You could argue that maybe that juice isn't worth the squeeze, but it's reasonable to consider. I mean, it's not out of the realm of possibility that that's the right strategy for $3,500. Now, here's where it becomes more interesting. Well, let's say you have you and your spouse and 2 kids, and they're both married, and they both have 2 kids, and all of a sudden now we have 10 people. Well, that's $350,000. And now all of a sudden we're talking about $35,000. And is all that work worth it for $35,000? Well, you know what? It might be worth it for $35,000. And the way that this law is written is they don't have a cap on the number of beneficiaries. And in fact, 529s have been designed that way on purpose. What will be really interesting about this, does it open up like that? It becomes this huge planning opportunity to transfer wealth in a more tax efficient manner than a traditional Roth contribution or otherwise, right? I can't even do that directly, for a lot of individuals, but I could through this technique. Does that 15-year rule apply if you add a new beneficiary? Now, there's no answer to that today, right? That is an open question that I imagine the regs here will eventually have to answer, because if not, if the answer is just the 529, kind of like the Roth, like the first Roth needs to be open for 5 years and you track back to that one. If we kind of follow similar rules, and it doesn't matter who the beneficiaries are, which would be my assumption, but the government might say, look, if we allow people to just add and change beneficiaries forever, this is going to open up so many opportunities to transfer assets, because we just set it up today. We don't even have to put the money in, and then in 15, 16, 17 years, we could super fund it and move the money out all over the next 5 years. So that will be interesting to watch. How do they deal with that? Because if they deal with it as it's written, it really does open up this opportunity. But that's a huge one to watch. I put that in the, how broad does this one go? Is it more tailored in, or is it really broad? If we can add beneficiaries without triggering a new 15-year time period, 2 things occur. 1, this becomes a very big wealth transferring vehicle under the current law if they don't change it, right? And 2, it also sets the stage for, you kind of go to every client like people were doing back in like 08 and 09, 2010, and saying, just get your Roth set up, get them set up, get them set up. And you might just go to all your clients, say, even if it's $1,000, just go ahead and set up a 529, because worst case scenario, we can roll that money to a Roth at some point in the future for yourself. If you have kids, if you have grandkids, even better, we'll be able to roll even more money to them over time. So I find this to be super, super interesting, really powerful planning technique. And one last part here, and before I hop over to the next CPE code, is if you look at this one, you know what else it's not subject to, this rollover? It is not subject to the Roth income limits. Meaning somebody like me, I hope for the next 15, 20 years that I make too much money to directly contribute to a Roth. I now have a lot of taxable IRA money, tax deferred money that's out there. So I don't do backdoor contributions anymore. Now, at some point I might roll that back to a different 401k or something like that and go back to doing them. But today I don't do that. And this would allow me to put the money in and roll it over to the Roth outside of those income tax, the income limits there. So super interesting, opens up another area. At a minimum, right, we're going to have to pay attention to this. Is this a more efficient way to save for retirement? Is it a better way to save for college now because we can move money? Is it a more tax efficient way to transfer wealth between generations? And can we, another backdoor way to contribute money to Roth, which is really opened up, for everybody anyway, but it is another wrinkle to it. So I find that to be super, super interesting. So I'll get
Jamie, we have a lot of questions in the queue, so we've got about presentation minutes left, okay?
Okay.
Thanks.
Do you want to just ask the question? We could go to questions after this. They're not showing up in my question box, so.
I'll read you the questions, 5 minutes.
All right. Well, we got the CPE code number 5, plans, 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 and we could just go to questions after this, and then we'll do the last code after questions. So my guess is there's a lot of really good questions since you just mentioned that, and if I run out, I can hop to some other things. So you want to go there?
Sure, Jamie, you ready?
I'm ready. Fire away. How
All
many
right,
questions
first question.
With 107.
First question, does the Savers credit apply to Roth contributions?
Yes, it would. And the match is going to be in Roth in in theory there. So it will apply for that too. That counts as a qualified savings aspect and will trigger it. So that's a great question. So Roth accounts, 401k, IRAs, 403bs, all will count towards that.
Thank you. Next question. Secure 2.0 says when a worker elects to treat an employer contribution as a Roth contribution, it must be non-forfeitable. Does that mean only vested people can elect to treat an employer contribution as a Roth contribution?
So no, but it will mean that those are vested at that period in time. Now, the part about the employer one, and so this is the wrinkle here, is that the employer contribution that you can elect to be a Roth moving forward is optional for plans to put in. So if a plan decides that I do not want you to be vested in that money, then I will not give you the option to elect Roth tax treatment of my contributions. It is not mandating that employers add that as a plan feature. It's an optional plan feature. Just like I could opt in that after 90 days, everybody is vested in the plan. Most people don't do that. So because of that, it's a really great point that there will be some plans that say, you know what, we have a lot of turnover. We've got young, low-income people. Most of them pick Roth. Most of them are going to pick Roth for the employer contributions, and I don't want to lose all that money, so I will not add that as a feature. There will probably be some companies that make that mistake, add it, don't think that through, and then they're like, man, we're making a lot of payouts here on vested accounts for people who have been here 90 days, 6 months. So it's a really great talking point. Super, super great, question. So I like that one a lot.
All right, I think this is a question from a fan. I love Jamie's concept on spending if you can afford the vacation, especially when the clients start the golden years. For me, starting at age 60.
Yeah, well, I want to add something here because this is, some of you probably know him, Steve Reish, and there's a CFP, there's two actually out there, but Steve's a good friend of mine, and he came to one of my presentations, I think in 2018 or 2019, and he had a retirement date set, which I think was 2020. He's still working, and he's told me now twice that the main reason he's still working is he saw that presentation. He had not gone on a vacation in like 3 years. He's gone on a vacation every year. He's going on a vacation this year again, and he bought a new car. And he's like, and what I realized was I was afraid to spend any of those things because I had my retirement number and picture in sight. And he's like, and so spending that additional 70 grand was like, well, I can't retire and do those. But it didn't even come to his mind that, you know what, if I do those, I might feel okay working longer. And so he's just continued to work now, and he spends more than he used to spend. And so I love the fact that I actually do know somebody that's actually followed that advice and has shown they continue to work. The worst part would be though, if you tell a client to spend all the money and then they retire at the same age. There is a downside part of that strategy.
You have to listen to the whole strategy, basically.
Yeah.
Next question. When is money forced out of a 529? Isn't it at age 32 for the beneficiary?
No. So you do not force the money out. Actually, you can save in a a 529 and go to school at age 70. There are actually people doing that here today out there. So you can set up a 529 for yourself and actually use it for college education expenses, master's degrees, those things when you retire. It's not a super popular strategy, but there is a Michael Kitcey's blog, I think, about that one. I think it's Kitcey's. It was Kitcey's or Ed Slott wrote a whole thing about like using 529 as part of a retirement strategy, because some of the, some of those university towns have actually really encouraged seniors to come back to school now and take like continued education learning stuff. And you can actually use that through the 529 also. So yeah, it does not have a specific age time period in which all the money is forced out. I mean, when you die, then there's a liquidation of it. And the tax implications of that are not super great in every case, but because you can put multiple beneficiaries on the owner's account, it does allow that ability to have grandkids, kids, other people access those accounts. So I'm not the best in the world at all 529, because remember, 529 is federal plus state rules. So different states do have different rules about, like, do you need separate accounts with separate beneficiaries? There's some details, as I said earlier, devil's in the details, and there are a lot of details that come into place with 529s. There's some great experts out there in that space. I know enough. I know my state's rules pretty well in a couple other states, but I do not know every state's rules on 529s.
Well, thank you, Jamie. And we've got another question. This viewer is still confused on the 10-year RMD rule for beneficiary IRAs after 2020 deaths. What table do you follow if you wish to withdraw each of the 10 years? What is the minimum withdrawal amount each of the 10 years?
Okay, I do. Give me a second and let me scroll through this. I don't believe I have it in this deck. I do have this though. So one is, it will depend on the beneficiary. So that's the first part, right? Like, there's not a simple answer to that. There are some charts out there that you can find, and if that person wants, I could get them one of mine. I do have ones that we use here at Carson. We've built those. The proposed regs changed this again. So I'm just scrolling through to see if I actually have this in this deck in the back end. I don't think so, because that is technically the first one. Treasury guidance, nope, 70 some slides, and it's not in this one. Let's try to do a super simple version of this. Now, there are some details here we'd have to go into, but I'll try to help at least a little bit. So the first part is, are we, an eligible designated beneficiary or a designated beneficiary or not? So there's kind of three categories we can fall into for the beneficiary. So that is the starting point. You have to figure out who the beneficiary is. And we'll just use kind of the three simple ones for purposes of this. So you've got spouses, you've got children, and you've got non-person entities. Think of your estate as the third one. Estates still fall to the 5-year rules. Children, unless they're minors to the age of 21, right? So if they're 30 years old, they will fall into that 10-year period of time. So you have to take distributions over a 10-year period of time. Spouses can still roll over to their own. They can elect to retitle, or they can leave it in the name of the deceased. Their rules really didn't, there are some minor changes. Generally speaking, though, spouses still have that flexibility to stretch, retitle, follow their own rules. So the main grouping is, we're talking about the kids and the grandkids, right? Those are the ones where the rules really change. So almost thinking second spouse to die type of situations if we're doing quality planning here. Then there are two different periods of time. Did the person die before the required beginning date or after the required beginning date? That again is another thing that we need to pay attention to, because what we didn't think this up until like 6 months ago. And we just thought, hey, it said 10 years. So by the end of the 10th year, all the money had to be out. That is how it's written. So there's two potential situations. Either one is, we have to do the at least fast as rule, meaning that we are going to have to take out distributions from year 1 to 9. That will essentially be kind of a stretch provision, and then the rest will be out at year 10. Or we'll have one where we don't have to take any distributions to year 10. So that's going to be like the really, it's a really terrible drawing. I don't think it helped with anything. But those are the two potential outcomes, is either we are going to have distributions if they died post required beginning date, 1 through 9, and then the remaining of the count at year 10. If they died pre that, we don't have to worry about that. So they died at 70, we're fine. All we have to do as the beneficiaries get all the money out by the 10th year following the year of death, which means we could take out 10% each year. We could take nothing all the way to year 10. That is up to us. We just have to deplete the account by the 10th year following the year of death of the owner. Versus the other rule, which everybody was surprised about because it, really it's applying two separate rules. One of them wasn't vacated by the Secure Act. The interesting thing is those proposed regs have sat for a while, so they're still not final regs. We're still waiting on that, but that feels like the correct IRS reading, but it's probably not the right policy reading. So those are the two potential outcomes in that scenario. But this has actually gotten super complicated. I heard a little bit about the trust conversation right when I hopped in at the end. There's a couple people that have, Natalie Schultz done some great work out there on, the retirement benefits going into trusts and the new way the proposed regs look at, how do we even determine who in the trust is going to be the qualifying life for this? That's changed a lot too, now post Secure Act proposed regs. So that's a super complicated area. I actually have like 6 pages of notes, I think, on my screen from those. So that's funny enough that I was like, that document's actually right here. I've got Natalie Schultz estate notes as a document that I have in my Word. So that one's super complicated. I hope that helped a little bit. But if you reach out, I can get you an actual PDF that shows that in a little bit better fashion than me talking without slides or anything else. But hopefully it helps a little bit. At least figure out who the beneficiary is. If it's the non-eligible designated beneficiary, we're going to have one of two options there, right? Which is, when did the person die, before or after required beginning date? And then that will set us to, are they going to take distributions 1 through 9 and then the remaining of the account in year 10, or do they have the flexibility to pick from 0 to 10 in there? And that's kind of the workflow tree that you're thinking about.
Thanks, Jamie. That concludes the list of questions. We're almost at the top of the hour.
Yeah, what was the last code here? I believe it's plans, even though I can't find it. So we have Hopkins. Did we do that one already? Maybe not.
No, that's actually CPE code number 6 is Hopkins.
Okay, so that is 6. Plans was the last one. Hopkins is the last one. So that is CPE code number 6 is Hopkins. Hopkins. Hopkins.
Well, now they'll remember your name, Jamie, if they weren't going to before.
Yeah, well, thank you. This was wonderful. Appreciate everybody for taking time out. Thanks for inviting me on to both Society and NAIFA. I appreciate all the work that everyone does there, the leadership, fantastic teams, and you guys put out, bring together great speakers and information here.
Thanks, Jamie. We really appreciate it, and you have a great day.
Thanks, everyone.
Wow, what a great presentation. And now for our third and final presenter, we have Brandon Buckingham. Brandon has a JD and an LLM in tax. Brandon, where did you get your LLM in tax? Can't hear Brandon.
Oh, no, I had myself muted. Sorry about that. I got my LLM from Boston University Law School.
Very nice. Brandon currently serves as the Vice President for the Advanced Planning Group at Prudential Retirement and Life Distribution. He and his team of tax attorneys, certified financial planners, and retirement and life insurance specialists provide technical, marketing, and sales support for all matters concerning variable annuities, individual life insurance, retirement, estate, gift, and income tax planning, as well as other advanced markets topics. Brandon, thank you so much for being here today. Please take it away.
Thank you. First of all, can you see my slides and can you see me and hear me?
Yes to both.
Yes, they're both perfect. Oh, well, hey, thanks for the opportunity to be here today. I listened to a lot of what Jamie said. I'm going to touch upon some of those points, but I'm also going to take it a little broader here, if you will. I truly believe that we are in a perfect storm for both estate and retirement planning. And I think we're in a perfect storm for estate and retirement planning, really for four fundamental reasons. One is inflation. For decades, inflation has been pretty modest, running between 2 and 3%, and really until the end of 2021, where it jumped to 7% last year. It hit 9.1%. Now it's between 5 and 6%. I think a lot of people are beginning to realize the impact inflation has on their current spending behavior. I don't think people fully understand the impact inflation could have on their future purchasing power, on their retirement income. Two, market volatility. We have experienced a lot of volatile markets over the last year or so, and I think a lot of people are concerned about staying invested in these volatile times. And this is where we need to help clients stay invested and not make rash decisions based on emotions alone. Three, legislative uncertainty. We saw a lot of proposed changes over the last couple of years that could impact some very popular retirement and estate planning strategies. Most recently, we saw the passage of the Secure 2.0 Act. I thought Jamie did a fantastic job hitting the highlights of those provisions. I think these changes create an opportunity to have those critical conversations with your clients, how these changes could impact them, but also influence and create some planning opportunities. And then four, taxes. How many people think taxes are going to go up? Everybody, right? Most of your clients think taxes are going to go up. The question is when and by how much. So I think for those four reasons, we are in a perfect storm for retirement and estate planning. So let me start with retirement planning. I love this slide. It's simple. It really addresses the fact that retirement income planning has changed drastically over the last several decades. A few decades ago, the vast majority of Americans can safely rely on a pension. They can rely more on Social Security than they probably could today. And relatively few had to save for their own retirement, right? If you're looking at it as a pyramid, that pyramid is now inverted, where fewer and fewer people have access to a defined benefit plan. Although Social Security is not going to go away, it's likely to make up a smaller portion of your overall income in retirement, and more will have to save for their own retirement. I think everybody on this call today would agree with that general premise. Let me put some numbers around it. Let's go back to 1988. What do you think the percentage of household wealth in retirement accounts back in 1988? What was the percentage of their overall net worth that were in retirement accounts back in the late 80s? And the answer I usually get when I'm speaking in front of a live audience is 5, 10, 15%. The actual number is 1%. 1%. If you think about it, back then, I didn't have to save for my own retirement. My employer did it for me, right? I could rely more on Social Security as a larger portion of my income in retirement. Fast forward today, you got a married couple with at least $100,000 of investable assets. Nearly 40% of their household wealth are going to be in retirement accounts, IRAs and 401k accounts and the such. And that says to me, over the last 3 decades, we've done a pretty good job talking to our clients about the importance of saving for retirement. Having those critical conversations, are you saving enough? How much should you be saving? Having those, what's your number type of conversation. But now when you got between 10,000 and 12,000 people retiring every single day, I think the conversation is going to change. And I think the focus is going to be less on the cash pile and more on the cash flow. And as a result, clients will need to manage those risks in retirement themselves, right? And those risks could be increasing taxes, it could be market risk, sequence of return risk, longevity risk, inflation risk. And I'm going to touch upon each of those risks in a little greater detail. For those of you who are trying to get CPE credit, here is the participation code number 7. The word here is estate. So again, for those, code number 7 for CPA participation to get credit, the code word is estate. Okay, let's talk about inflation risk. This is a slide that shows inflation for 32 years, for the past 32 years. And you'll notice most of those years, inflation has been pretty modest, running 2 to 3%, until recently, till 2021, jumps to 7%, last year 9.1%. And like I mentioned before, I think a lot of people are beginning to feel the impact of inflation, at least on their current spending behavior. And as a result, people are worried. 76% of people are worried or very worried about the impact of inflation on their financial plans. Apparently 4% is not worried at all. I don't know who that 4% is. And as a result, they're changing their spending behavior, their spending habits. 53% are cutting back on dining out. 39% are cutting back on driving. Nearly a third are canceling or delaying a trip or vacation, delaying the purchase of big items like a car. They're borrowing more money or they're spending on credit. Again, inflation, I think a lot of people are beginning to feel the impact of inflation on their current spending behavior. And specifically retirees. These retirees have a higher rate of inflation than non-retirees. There's a separate index called CPI elderly or CPIE. And retirees have a higher rate of inflation, really in large part due to healthcare costs, where healthcare costs have been running almost double that of inflation for the last since 1982. And this is the impact on the future purchasing power. Again, I think a lot of retirees don't fully understand, or near retirees, the impact inflation could have on their future purchasing power, on their retirement income. If inflation stays high, let's say at 6%, that could reduce purchasing power by 71% in 20 years. And again, we need to plan for at least 20 years in retirement. If inflation does revert back to the norm, let's say 3%, at a 3% rate of inflation, that's going to reduce purchasing power by 44% in 20 years. Okay, what does that mean in dollars? Well, let's take a look at what $100,000 is worth today. At a 6% rate of inflation, in 20 years, $100,000 is going to be worth $29,000. And if inflation reverts back to the mean to 3%, and obviously the goal here is to get it back to 2 to 3%, but even at a modest rate of 3%, $100,000 today will be worth $54,000 in 20 years. So that's a significant impact on the purchasing power for those who have longer retirements. And then you think about longevity risk. And we all know what longevity risk is, right? This is the risk that you're going to run out of money before you run out of breath. But it's so much more, right? Longevity risk is a multiplier risk. The longer I live in retirement, the more likely I'm going to experience more than just a couple bear markets in retirement. The longer I live in retirement, the greater the impact inflation will have on my purchasing power in retirement. Now, one good way to mitigate against inflation, I think we all know this, is equity exposure. You take a look at the S&P 500 for the last 30 years, the S&P 500 has generally outperformed, usually substantially outperformed inflation. So equity exposure is a good way to manage and mitigate inflation risk. The problem is this: people are nervous about being invested in the current market. Although they understand that might be a good hedge against inflation risk, the volatile markets have got people a little nervous. And obviously this is where we need to remind people that no bear market lasts forever. We have recovered from every single bear market in the history of markets. And when you are retired, you are likely going to experience a bear market or two. And the longer you live in retirement, the more likely you're going to experience more than just a couple bear markets. Going back to 1945, there have been 12 bear markets with a 20% loss or greater. The average bear market loss is 35%. The average bear market will last 16 months, and it takes on average 25 months to recover from the average bear market, assuming you stayed invested. If you pulled out of the market, it may take you longer to recover from an average bear market, or that loss becomes permanent. And then this is where I really talk to clients about the mathematics of loss. I hear this all the time from clients. Well, my account's down 20%. So I need a 20% gain to get back to even. No, if your account's down 20%, you need a 25% gain to get back to even. Right? If your account's down 30%, you need a 43% gain to get back to even. And if your account's down 50%, you're going to need a double or 100% to get back to even. Now, in retirement, the mathematics of loss is actually different. So the gray bar here on the screen, excuse me, that's my withdrawal rate. So let's assume I'm retired and I'm withdrawing, let's say 4% from my retirement accounts for income purposes. And I just experienced a 30% market pullback. Now I need a 63% gain over the next 3 years to get back to even and to recover from that 30% loss. So the mathematics of loss is different in retirement in the distribution phase as opposed to the accumulation phase of retirement planning. And then when you experience those returns matter, right? When you're saving for retirement, the sequence in which you experience your returns actually does not matter. It's the average rate of return that matters. And it doesn't matter if I start saving for retirement in a bear market and end in a bull market, or if those those returns are reversed, right? It's the average rate of return that matters. But in distribution, the sequence in which I experience those returns matter greatly, right? If I happen to retire into a bear market as to a bull market, I increase the likelihood I'm going to run out of money before I run out of breath. This is the luck factor. That's all sequence return risk is. It's the luck factor. Am I lucky enough to retire into a good market as opposed to a bad market? Now, how can we manage some of that risk? I like to use an acronym here. And I use the acronym ART, A-R-T. I can avoid it. This is my in-laws, by the way. They were terrified of the market. They kept all their money in a savings account at their local bank or under the mattress. They never invested in the equity market. I can retain that risk and just hope for the best. Well, hope's not a plan. Or I can transfer some of that risk to an insurance company that can better manage that risk. Now, for those following along for the CPE credit, here is where code number 8. Code number 8 would be my last name, Buckingham. So CPI participation code number 8 is Buckingham. So let's talk about some of the ways we can mitigate some of these risks through life insurance. And this is just a kind of a quick bullet point. Obviously, if I have an exposure to a life insurance policy, you can maybe tap into the cash surrender value of that policy in years when the market is down to help preserve more of your traditional retirement accounts to help mitigate against that sequence of return risk. There are some products out there. I'm not going to do a product pitch here, but there are some solutions out there that will allow you to participate in the market, follow a certain index, for instance, have the upside potential of the market, to have maybe some floor or downside protection. Certainly use life insurance to protect the surviving spouse against inflation risk. You know, it is the surviving spouse that bears the biggest brunt of longevity risk. And since this is the surviving spouse that bears the biggest brunt of longevity risk, they have the biggest risk of inflation, reducing the purchasing power years later. Also, think about features in the life insurance policy that may help mitigate against inflation risk, such as an increasing death benefit, or through equity exposure by using a VUL policy as a way to hedge against inflation. Okay, so talk about market risk. We'll talk about inflation risk. Let's talk about tax risk. You know, how many people here think taxes will go up? I think everybody, right? I think all your clients do too. The question is when and by how much. And this is the reason why I think taxes will eventually have to go up. First, take a look at our federal deficit for the last 3 years. You know, in 2020, we had a record deficit of 3.1 trillion. In 2021, the deficit was slightly smaller, 2.8 trillion. Last year, about half of that, 1.4 trillion. So it's getting better. But the annual budget deficits, as high as they are, they're adding to the national debt. And our national debt now is over $31 trillion, 31 trillion. And then you take a look to our debt to GDP ratio, where the debt to GDP ratio is now approaching 100%. So do I think we'll see some changes? I do. On top of that, take a look at where our spending is. You know, 71% of our federal spending is for mandatory non-discretionary expenses. 71% of our tax revenue is supporting mandatory non-discretionary expenses that include Social Security, Medicare, Medicaid, certain entitlement programs, interest on the debt at 6.8%. Obviously, as interest rates increase, that debt obligation will also increase. That really leaves 29.3% to pay for everything else. And if we don't see any changes to either our tax system or spending, it's anticipated by 2041 that 100% of our tax revenue will be consumed by just the mandatory non-discretionary expenses, really leaving nothing else to pay for everything else. So do I think we'll see some changes? I do. The question is when and by how much. What I want to do now is cover some of the most recent tax proposals that were part of the White House 2024 budget proposal that was introduced in March. I'm going to cover some of these. Some of these are kind of a repeat, right? Some of these same proposals were introduced in the 2023 budget proposal. Some of these same proposals were part of the Build Back Better Act, also the 99.5% Act. So will these pass this year? Who knows? Maybe, maybe not. But, you know, we kind of know what the plays they want to run, right? You know, and by having a copy of their playbook, if you will, that gives us a better opportunity to prepare for some of these potential changes should they become real. So under the 2024 budget proposal from the White House, one thing they did propose is to increase the top tax rate, which is currently at 37% to 39.6%, but drastically lower the threshold in which you hit that 39% tax rate. You'd hit that top tax rate as a single filer as soon as your income exceeds $400,000. As a joint filer under this proposal, as soon as your joint income exceeds $450,000. Put that in perspective. This year in 2023, you don't hit the top tax rate of 37%. So your income is $693,000 as a joint filer. So this would be a massive acceleration and widening of that top tax bracket. And a lot more people will get there a lot sooner. There's also a proposal to increase the long-term capital gain rates. Right now, the long-term capital gain rates, as you probably know, is 15 to 20%, depending on your income limit. You add that 3.8% Medicare surtax. That means you can have a top income long-term capital gain rate, of 23.8%. Under this proposal, if you make over $1 million, your long-term capital gains will be taxed at ordinary income rates. And don't think about just those people that make annually over $1 million. Think about those clients that may have a one-year event where they make over $1 million. They retire and they cash out their non-deferred comp plan. They sell a business or they sell a home or other real estate that pushes them over that $1 million threshold. That means for those taxpayers under this proposal, their top long-term gain tax rate will be 43.4%, right? 39.6% plus that 3.8% Medicare surtax. There's also something called the billionaire's tax. Actually, it increased under this budget proposal from 20 to 25%. And this would apply for those that have a net worth over $100 million. And if you have a net worth over $100 million, you're going to have a 25% minimum tax on all income, including unrealized gain. That would be a drastic departure from long-held tax policy that generally requires there being a triggering event for there to be a taxable event. Here, there's no real triggering event. Someone just has a net worth of $100 million. That means that all their unrealized gains will be taxed at that year. We'll see if that passes. There is a proposal to limit who can do a Roth conversion. Jamie talked about Roth conversions. I'm going to talk a little bit about it. I think it's a great opportunity for certain taxpayers. But under this proposal, if your income exceeds $400,000 as a single filer, $450,000 as a joint filer, you will not be able to do a Roth conversion. Also, there's a proposal to increase that Medicare surtax. I mentioned before, 3.8% surtax for those that make over $200,000 single filer, $250,000 joint filer. But by the way, when that 3.8% Medicare surtax was originally passed, those income thresholds were the same. Those income thresholds have not increased since that was originally passed about a dozen years ago, which means because of inflation, you're going to see more and more taxpayers be subject to this dreaded 3.8% Medicare surtax. Well, under this budget proposal, if it passes, that 3.8% surtax will go to 5%. Transfer of appreciated property. You know, right now, if I were to gift a highly appreciated capital asset to my kids, for instance, they would pay no income tax. There might be a gift tax, right? There might be a gift tax associated with that, but there's going to be no income tax at that time of that transfer. They would just simply inherit the cost basis of that asset, and then when they later sell it, they'll pay the tax on the appreciation that occurred while I own that property. Under this proposal, there will be a gift tax implication, but also an income tax implication, where you have to pay tax on the unrealized gain at that point in time of transfer. And if I were to transfer that highly appreciated asset on my death, upon my demise, right now there's a step up in cost basis, and the cost basis steps up to fair market value at the time of my death, which means my kids or whoever inherits that asset, when they later sell that highly appreciated asset, they won't pay any tax on the gain that occurred while I was alive and I owned that property. Under this proposal, you lose the step up in cost basis, and there will be immediate realization of taxes. So think about that for a second. If that passes, I think you see a lot more people buying life insurance, not just for estate tax purposes, but also income tax purposes, to provide liquidity to pay the resulting tax liability so they can keep that family asset in the family. So think about those assets that you want to keep in the family, whether it's real estate, a business, or any type of just capital asset they want to keep in the asset. If this passes, again, I think life insurance will be used more to help pay the resulting tax liability. There's a proposal to change the grantor retained annuity trust rules so that there will be a minimum term of 10 years and that the remainder interest must equal at least 25% at the time of the funding. If this passes, what will that do? Well, that'll get rid of the whole short-term zero-out grants or the rolling 2-year grants, zero-out grants. So we'll see what happens with that. And then grantor trusts, you know, very popular planning tool, setting up intentionally defective grantor trust that might be irrevocable for estate tax purposes, but not income tax purposes. And by having it defective in that regard, I can sell an asset to that trust and there'd be no tax implication because it's treated for income tax purposes as if I'm selling it to myself, right, as a grantor. And then if there's income generated in that trust, I can pay taxes at my personal tax rate, which is a lot lower than the trust level income tax rate. And by paying the tax liability, I'm preserving more of those trust assets to pass on to the next generation upon my demise. Under these proposals, any transfer or sale to a grantor trust, although treated for income tax purposes as being the grantor's income, would recognize taxation upon that transaction. And then if the grantor were to pay the tax liability on any income tax, that would be treated as a taxable gift. Again, these are all just proposals, but we're beginning to see what their play plan is, what plays they want to run. And that really does help us prepare for potential of these changes. Now, we do know if these don't change and they don't pass, we know in about 2.5 years, end of 2025, the Tax Cut and Jobs Act will sunset and we'll go from a top rate of 37% to 39.6%. So we should be planning for that eventuality sooner than later. And when you're talking about tax diversification, especially now in a changing, likely rising tax environment, I think tax diversification becomes that much more compelling. You know, I have no idea what the tax environment is going to look like when I decide to retire. And because I have no idea what the tax environment is going to look like when I decide to retire, over time, I want to tax diversify my retirement portfolio. Now, I want different buckets. I want my tax deferred bucket, you know, that would be my IRAs, my 401k accounts, my non-qualified annuities. I want my taxable bucket, that would be stocks, bonds, mutual funds, managed money, and my tax-free bucket. And that tax-free bucket, for the most part, will probably be Roth accounts, Roth IRAs, Roth 401k accounts, and cash value life insurance. And by having a tax-diversified retirement portfolio, I'm in a much better position to manage my tax liability. And I think if you take a look at your clients' buckets, you may have a lot of clients who have a lot of money in a taxable bucket. They may have a lot of money in a tax-deferred bucket. That tax-free bucket, for many, will be empty. And if that tax-free bucket is relatively empty, I think that creates an opportunity to have conversations with your clients about the best ways to help fill that tax-free bucket up. And I think Roth conversions, especially now, is certainly one compelling way to help fill that tax-free bucket up and better tax diversify your client's retirement portfolio. And I think Roth conversions are very compelling now for two reasons. One is the current market conditions. We had some pullback last year. Will we recover from that pullback? Probably, yes, right? We have recovered from every bear market in the history of market. The question is when. If you or your clients believe that eventually we will recover from that market pullback, maybe it makes sense to convert now while the taxable value of that account is depressed, and any subsequent recovery then will be tax-free. But also maybe convert now while the tax rates are at historic lows, right? And I truly believe that we are in a historically low income tax environment currently. I would even suggest the lowest tax environment we've seen in generations. I know some people say, well, what about the Reagan years where the top tax rate was 28%? That's certainly lower than the top tax rate now. That's true, but you got there a lot sooner than you do now. So this might be a good time to convert now while the tax rates are at historic lows. And by the way, that would be a great hedge against rising taxes if you think taxes will go up. And another way to fill that tax-free bucket up is through cash value life insurance. And this is a slide I really like to kind of illustrate the various tax benefits of life insurance and the Internal Revenue Code sections that provide those benefits. So we got section 101A. 101A provides that the death benefits are generally income tax-free when paid to the beneficiary. You have section 7702 of the Internal Revenue Code. That provides that the cash value of that policy will grow on a tax-deferred basis. Recent changes over the last couple of years to section 7702A that allows you to actually put more money into that life insurance policy that can grow on a tax-deferred basis and still qualify as a life insurance policy. You have section 72. That generally allows you to tap in while you're alive the cash value of that policy up to basis from a non-MEC policy, income tax-free. And then you get section 101G. This provides the insured, the owner, to accelerate the death benefit tax-free in the event of need for chronic or terminal illness. So these are some of the tax benefits of life insurance, and why life insurance, including Roth accounts, can help better to tax diversify your overall portfolio. And then think about life insurance in retirement planning. Again, this is just a laundry list of some of the benefits. I'm not going to spend a lot of time on this. Obviously, you have the death benefit protection. Primarily, that's why you buy life insurance. You have the ability to, while you're alive, invest and have that cash value grow on a tax-deferred basis. You can generally tap into the cash value income tax-free. It's a great hedge against premature death. It's a great hedge against increasing taxes. Having additional sources or supplemental tax-free income is certainly a good hedge against rising taxes. Withdrawals are not subject to that 3.8% Medicare surtax. It does not increase your modified adjusted gross income, so that will have no impact on your Part B or Part D of Medicare premiums. It does not affect Social Security benefits. Social Security benefits could be taxable depending on what your provisional income is. Withdrawals from a life insurance policy that generally are tax-free will not increase your provisional income that could subject your Social Security benefits to more taxation, and then you have greater use and control over the cash value. So those are some of the key benefits of what we call alert strategy, or life insurance and retirement planning. So that was retirement planning. Let's switch gears here and talk a little bit about estate planning. Right now, the gift tax and the estate tax, the maximum tax is 40%. The exemption this year is just under 13 million, 12.92. We do know in 2.5 years that Tax Jobs Act will sunset, and the exemption will reduce down to 5 million. Now that exemption is adjusted for inflation, so with the 5 million exemption adjusted for inflation in 2026, that should be around just about 7 million or so. So that's a drastic reduction in the current estate tax environment. When I started practicing law 32 years ago, I was an estate planning attorney in private practice. Back then, some of you may remember this, the estate tax exemption was $600,000, and a 55% estate tax on estate above that $600,000. back then, every single of my clients had a comprehensive estate tax plan. Every single one of my clients had a life insurance trust. Now the exemption is this high. I know some people are a little bit hesitant by doing any comprehensive estate planning, right? Well, the estate tax exemption is $13 million. I really don't need to worry about it. Well, you may not have to worry about it now, but with the estate tax exemptions coming down in the next couple of years, you may have a problem in the future, right? So let's assume I had a $5 million estate. And I understand that the current estate tax exemption is almost $13 million. I'm not really motivated to do any comprehensive estate tax planning, but maybe I should be. Because let's assume that $5 million estate grows at a modest rate of 4%. At a 4% rate of inflation, so I'm in the middle column here on that slide, that $5 million estate growing at 4% in 10 years will be worth more than $7.4 million. In 20 years, nearly $11 million. If an estate worth $8 million now, in 10 years, that's going to be worth almost $12 million. So even though you may not have an estate tax issue now at the federal level, you may have one in the future if your estate continues to grow and the estate tax exemptions continue to come down. And by the way, because the estate tax exemptions have changed drastically over the number of years, I think this creates a perfect opportunity to sit down and review your client's will and estate plan. And we see this all the time, right? People will draft an estate plan, they'll draft a will, they'll draft some trust, they'll put it in a folder, they'll put that folder in a file cabinet, they'll close that file cabinet and they forget about it and they don't review it for a decade or two. And we want to make sure that their current estate tax plan and their will and trust reflect the current and yet changing estate tax environment we've been living through and will probably continue to live through over the coming years. And then that brings me to my state level estate tax. You know, you may not have a federal estate tax concern, but you may have a state level estate tax concern. You know, there are 18 states, including the District of Columbia, that have either an estate tax or an inheritance tax. And that exemption to be low is $1 million. That's where I live in Massachusetts, $1 million estate tax exemption at the state level. And the state level estate tax will be high as 20%. So even though your clients really haven't done any major estate tax planning at the federal level, they can't ignore the state level potential taxation. Okay, so that's taxes. We talked about market volatility, we talked about inflation, we talked about legislative uncertainty, we talked about rising taxes. Let's talk a little bit about the most recent legislative change that could impact, will impact retirement planning strategies. I'm not going to go into deep dive like Jamie did, but I do want to talk about a couple things and maybe just echo some of Jamie's comments regarding the Secure 2.0 Act. One is the R&D age went from 72 to 73, goes to 75 in 10 years. I think a lot of your clients will probably think this is welcome news, right? However, I think it's important to have a conversation with your clients. Does it make sense to continue to delay to take distributions, right? Because now with a later R&D beginning age, those R&Ds will now be bigger. And that means higher taxation for the retiree, maybe pushing them into a higher tax bracket. Then that can have that cascading effect of increasing the taxation you pay on your Social Security benefits and increasing the premiums you pay for Part B and Part D of Medicare. So for certain people, maybe it makes sense not to wait till your R&D age. Maybe start tapping into those accounts earlier. And if they don't want to spend it, think about doing Roth conversions and do it annually, serial, strategic Roth conversions. And by doing that, you're spreading that tax liability over a longer period of time. You're reducing your overall taxes in retirement, and that could have that cascading effect of reducing the taxation you pay on Social Security as well as reducing the Medicare premiums you pay. Increase catch-up contributions. So last year, if you were age 50, you can do a catch-up contribution of $6,500 into your 401k plan. This year, $7,500. Next year, it'll be $10,000, but only for those people ages 60, 61, 62, 63. Why those 4 years only? I have no idea. But for those clients, they can do a catch-up contribution of $10,000 for those 4 years. And then after 2025, the catch-up contributions will be indexed for inflation. You're going to see an expansion of the Roth opportunities. right? Beginning this year, you can do a Roth contribution into a SEP IRA or a simple IRA. Employer contributions beginning next year can do either pre-tax or Roth, right? I get this question a lot. If the employer does allow for a matching contribution to be in a Roth account, is there a tax benefit to the employer? Not really, because whether the employer is making a pre-tax or a Roth matching contribution, they're going to get the tax deduction. It's really the tax benefit to the individual, to the participant. Where if they elect to receive it on a pre-tax basis, then it's tax deferred, and they'll pay tax on it later on when they withdraw from that pre-tax match contribution account. If they take it in a Roth account, they'll recognize income in the year that Roth contribution is made by the employer, and obviously that'll go tax-free. Eliminate RMDs for Roth accounts. So Roth IRAs, as you know, were never subject to RMDs. Roth 401k accounts always were. Now it's kind of easy to avoid, right? Before you hit your RMD age, you can take an in-service withdrawal and roll that Roth 401k money into a Roth IRA, and that would therefore prevent you from having to take an RMD. But beginning next year, Roth 401k accounts will not be subject to RMDs, which means Roth 401k accounts and Roth IRAs, there'll be some parity between the two. 529 plan rollovers for Roth IRA. You know, Jamie spent some time on this. I'm not going to spend too much time on this, but basically the rules here are the 529 beneficiary, not the owner. The 529 beneficiary will have a right to roll up to $35,000 into a Roth IRA so long as they have earned income. Also, they can't roll the full $35,000 at once. It's subject to annual contribution limits, which is $6,500 to $7,500 if you're over for age 50 or not. So you can take advantage of $35,000 in rollover over many years. That 529 account has to be open for at least 15 years, and the last 5 years of contributions or attributable earnings are not eligible to be rolled over. What does this mean? I'll give you an example. I'll use my kids as an example. I have 2 kids in college. Started their 529 plan right after they're born, so it's been open for more than 15 years. I have a son who's a freshman at University of Southern California. So he picked probably the most expensive school to go to. So when he graduates and his academic career is over, there's not likely to be anything left in that 529 account. My daughter, on the other hand, she's a sophomore at Northeastern, and she got there by way of an academic scholarship. So when she graduates and her academic career is over, it's likely that she'll have plenty of money in that 529 account that she can roll over to her Roth IRA, assuming she has earned income. But wait a minute. I'm the one who funded that 529 account. I would like to take that money back, that $35,000. Can I change the beneficiary from my daughter to my wife, for instance? The answer is yes. That would be a qualified family member. Can my wife now take out that $35,000 over a number of years into a Roth IRA, assuming she has earned income? The answer is yes. What's not known is how that 15-year rule works. Is it that the account itself has to be open for 15 years, or does the beneficiary have to be on that account for 15 years? More to come. We'll find out hopefully sometime before next year when this opportunity becomes available. Other question I get is this. Let's assume we change the owner from my daughter to my wife, and over several years she rolls $35,000 into a Roth IRA. Can she change the beneficiary from her to me, and do I get another crack at that $35,000 rollover? Don't know yet. More to come. The RMD penalty is being reduced from 50 to 25%. There's going to be a retirement savings lost and found. So, you know, believe it or not, there's 1.3 trillion with a T in unclaimed retirement assets. How does that happen? Well, people have short-term jobs. They don't stay long. There wasn't a lot of money in that account. They forget about it. They move. Their statements never make it to their new address. So now there's going to be a centralized database set up by the Department of Labor where people can type in their name to see if there's any unclaimed retirement assets in their name. Now, there is also some changes and updates to the stretch rules. And Jamie talked about this as well. As we know, the original Secure Act pretty much eliminated the stretch opportunity for most non-spousal beneficiaries. Most non-spousal beneficiaries will now have to liquidate that inherited account within 10 years. Why did Congress make this change, by the way? One reason, to raise revenue. They anticipate this one change alone will raise $15.7 billion. It won't. And the reason why it won't is the vast majority of people, when they inherit an IRA or 401k account, what do they do with that inheritance? They spend it, right, as soon as they can, on the way to the funeral, if they could. But those clients of yours that have been maximizing their contributions into the retirement accounts, oversaving, if you will, anticipating, hey, whatever I don't spend in retirement, my kids or my grandchildren will have this great benefit of stretch. This will be a massive acceleration of taxes for those beneficiaries, likely forcing those beneficiaries into a higher, if not the highest tax bracket, resulting in more of those assets lost to the IRS. So I think this change will do a couple things. I think it'll encourage more people to spend more of their retirement assets on themselves in retirement. And that's the purpose of these accounts, right? That's the reason why they're tax qualified in the first place, as a tax incentive to encourage people to save for their own retirement. And then find other assets to leave as a legacy that might be more tax efficient, life insurance. So now, last year, before last year, the IRS had provided some guidance on the 10-year rule. And before last year, it was generally assumed that you didn't have to take required distributions years 1 through 9. You can simply wait till the last day of year 10 before that beneficiary would have to liquidate that inherited retirement account. Then last year, the IRS says, well, no, there could be RMDs years 1 through 9, depending on how old the decedent was when he or she died. If the decedent died after age 72, therefore subject to RMDs, their non-spousal beneficiaries who are subject to that 10-year rule will have to take RMDs years 1 through 9 based on the beneficiary's life expectancy. If the decedent died prior to age 72, therefore not subject to RMDs, then the beneficiary who is subject to the 10-year rule could simply wait to the last day of year 10. So now we basically have 3 different types of beneficiaries for qualified retirement accounts. You have your eligible designated beneficiary. So these are beneficiaries that can still stretch. Excuse me, a spouse can still stretch in an inherited IRA or 401k account. By the way, why would a spouse ever elect a stretch payout? Really for only one reason I can think of. If that surviving spouse was under the age of 59 and a half and needed the money, if he or she were to assume that contract, that IRA, into his or her own name and takes a withdrawal, there could be 10% penalty. There's no 10% penalty from a distribution of an inherited IRA. Minor children can still stretch over their life expectancy until they reach the age of majority, 21, then it switches to a 10-year rule. The key here is minor children. Got to be a child, minor child of the decedent, the IRA owner or the 401k owner. So minor grandchildren, nieces, nephews, unrelated minors, subject to the 10-year rule. Beneficiaries who are disabled or chronically ill, they can still stretch over the life expectancy. Beneficiaries who are not more than 10 years younger than the decedent, they can still stretch over their life expectancy. So for instance, if I were to leave my IRA to my sister is a couple years younger than me, she can still stretch that IRA over her life expectancy. And then certain trusts, we'll talk about that shortly. Everybody else will be considered a non-eligible designated beneficiary. When I say everybody else, I'm talking about every other non-spousal beneficiary, subject to the 10-year rule. They may have to take RMDs years 1 through 9, depending on the age of the decedent. And then you have your non-designated beneficiaries, subject to the 5-year rule. So these are your estates, right? Your trusts, charities, and estates. Now, let's talk about what happens when a trust is a beneficiary of a retirement account or an IRA. And the rules here get pretty complicated. And I'm not going to give you every variation of the distribution rules, because if I did, we'll be here till Thursday. But the rules will vary depending on the type of trust it is. Is it an accumulation trust? In other words, are those assets being accumulated and invested to pay out at a later time, when that trust beneficiary attains a certain age, whether it's 30, 35, or 40? Is it a conduit trust, meaning all the distributions received by the trust are paid out in the same year to the beneficiary, to the trust beneficiary? Who are the trust beneficiaries? Are they eligible? Are they non-eligible? Do you have different tiers of trust beneficiaries? The long story short is this. For the vast majority of these IRAs or the 401k trusts out there, that IRA, that 401k trust will have to be liquidated and paid to the trust within 10 years. And that trust could be a ticking tax bomb. Now, a couple exceptions. One is if you have a special needs trust. If the trust beneficiary is chronically ill or disabled, and if that trust beneficiary who's chronically ill or disabled is the only one entitled to income from that trust, in that case, you can stretch that retirement account to that special needs trust over the life expectancy of the special needs trust beneficiary. If the trust provides for a minor child, even if there's other trust beneficiaries, you can ignore the other trust beneficiaries and you're allowed to stretch that IRA to the trust over the life expectancy of the minor child until that minor child reaches the age of majority, then it switches to a 10-year payout. Everybody else is going to be a 10-year payout. And why I think this could be a ticking tax bomb is you take a look at the income tax rates for trust, subject to a very, very compressed income tax bracket, where you hit the top tax rate of 37% as soon as the income exceeds $14,450. This is income earned or received, in this case received by the trust. So if I have a 401k or an IRA that's worth more than $14,450 that now has to be liquidated within 10 years, you can be forced in a higher tax bracket. So I tell people, if you have these IRA trusts and these 401k trusts, but by the way, most of these trusts were drafted before the Secure Act. They're drafted to be a look-through trust, meaning they're drafted so before the Secure Act, you can look through the trust, pick the oldest trust beneficiary, stretch that IRA or that 401k account to the trust over the life expectancy of the oldest trust beneficiary. In other words, it was designed to preserve the stretch capability. Now when it passes with the Secure Act, most of these trusts, most of these IRAs or 401k accounts have to be paid and liquidated to the trust within 10 years. I tell clients, if you have a retirement trust, an IRA trust, you're going to need to talk to your attorney to make sure it's still a viable strategy, or you may want to make some changes to that trust or find other assets to fund that trust with. Okay, CPA participation code number 9, TAX. That's the code TAX, T-A-X, CPA participation code number 9. Okay, so I just got a few more minutes here. What I want to do now is kind of end with a case study. And we're taking a look at Don and Kathy Boge, age 65. They have one daughter, age 30. They have some retirement assets that they don't anticipate that they're going to spend during their lifetime. Matter of fact, they have earmarked $500,000 of those IRA assets to pass as a legacy to their daughter, Barbara. They have enough money in their other investments. They have a defined benefit plan. So they figured, hey, $500,000 of these IRA assets we want to pass to our daughter upon our demise. And let's assume they live another, let's say, 18 years. That $500,000 IRA is growing at a rate of 5%. So upon their demise, when Barbara inherits this IRA, let's assume it's worth $723,000. And again, let's assume she can take advantage of stretch. So these are the old rules. These are the pre-Secure Act rules. And she takes her RMDs and only her RMDs and no more. And if that IRA grows at a rate of 5% over her life expectancy, if she lives to her life expectancy, she's going to receive in total income nearly $2.4 million. Now with the passage of the Secure Act, she's going to have to liquidate that account in 10 years. If she would take a lump sum distribution in year 1, that $723,000 will push her into the higher tax bracket, the highest tax bracket, and her effective blended tax rate will be $222,000. That would net her about $500,000 after taxes. If she waited to year 10, by the way, that number would be closer to $600,000. Big difference, however, from the $2.6 million. So instead, what they do is they talk to their financial advisor. They decide, okay, that $500,000 of IRA assets that we have earmarked will pass to our daughter, Barbara. Why don't we start tapping into that? And let's say we take $20,000 a year, and we buy a second to die policy that provides a death benefit of nearly $1.3 million, maybe a little bit more. And now look at the difference. $500,000 if you were to simply liquidate that IRA and pay taxes all at once. If she used this asset protection strategy where we're repositioning some of those unneeded retirement assets into a life insurance policy. She'll receive about $1.6 million after taxes, right? The $1.3 million of the tax-free death benefit from the life insurance policy and the remaining taxable IRA assets. Okay, I covered a lot here in a short period of time. It's probably like taking a sip from a fire hose. Let me kind of end where I began. I think we're in a perfect storm for retirement and estate planning. I think we're a perfect storm for retirement and estate planning for 4 fundamental reasons. Inflation, market volatility, legislative uncertainty, a changing rising tax environment. I think clients need your help more than ever to navigate this perfect storm. So that was the end of my comments.
I want to make sure that we thank Brandon for his time today. We really appreciate your presentation. Great job, and we'll look forward to seeing you again on another future presentation. I want to remind all the attendees, first, when you log out of the webinar, you will be directed to an evaluation. Please take a moment to complete that evaluation. Your feedback is always appreciated, and it's necessary for us to plan future APC programs that are of interest to you. As a reminder for those that need accounting credit, you will need to enter all 9 of the CPE participation codes that appeared during the webinar on the last question of the evaluation. On behalf of the Society of FSP, NAIFA, and our collaboration, the Advanced Practice Center, thank you again for attending today. And thank you so much to our sponsors, Emeritus, First Financial Resources, Mutual of Omaha, and Pacific Life. And thank you all for your participation today. Keep an eye on your email for future APC programs. With that, the conference is adjourned, and everybody have a great day.